I don't think this is a bubble.
The market is still going to keep wanting some kind of proof.
I would look at it as a race to try to be in the lead.
This will be a buyable moment.
Momentum has been such a strong strategy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Friday, investors on edge. Equity markets heading for their worst week in 7 months. Solid earnings from Nvidia failing to put a floor under confidence. And very few signs officials at the Federal Reserve are coming to the rescue. The hawks remain defiant.
So let's give you a sprinkling of what we heard yesterday. Chicago Fed President Austin Goolsbee saying that inflation seems to have stalled out and, if anything, has given warnings of going the wrong way. Cleveland Fed President Beth Hammack raised concerns about financial stability, saying that if you do get this in risk-taking in financial markets, it will prolong the downturn one after another, lining up to signal whether they are on the hawkish or the dovish side, or whether they're squarely in the uncertain center of the FOMC.
The biggest one-day reversal on the S&P 500 going back to the tariff turmoil of April this year. The company story's okay. We saw that with the earnings of Nvidia. The stock story is not okay. The way this market has reacted to incoming information has shifted over the last few months. We saw it with Palantir. Decent numbers, poor stock market reaction. We saw it with Nvidia in a more vicious way in yesterday's session.
So there is a narrative you can paint, and you can paint about 16. You can choose your own, because nobody can really coalesce around one in particular, that there is a fear that valuations have just gotten ahead of where all of the AI hopes and dreams can go without significant debt investment, which is making people queasy. It's the reason why you haven't had the buy the dip kind of feeling. OpenAI is causing a lot of agita, and we're seeing that across the board, anyone who's connected to OpenAI. Then there is another feeling, which is essentially positioning has gotten to a place where hands are very weak. And that's what I think a lot of people are pointing to, particularly with the crypto sell-off. I know we don't talk about crypto that much, but I think the sell-off in Bitcoin, 30% decline since the recent high, that's a lot of money going out, and a lot of questions around what kind of forced selling there might have.
Without a doubt, one informs the other. One informs the other. Again this morning in the pre-market, Nvidia a little bit softer. That stock is down by 1.5%. We'll track that for you throughout this morning. So what does the White House want? What does the Treasury Secretary want? The White House and the Treasury Secretary want the obvious. They want lower interest rates.
The Treasury Secretary made that point again last night, speaking on Fox News, saying we should finish the current cutting cycle, and the Federal Reserve needs to continue cutting interest rates. At the same time, this is a difficult line for them to walk, because they also want to make sure they are touting that they think the economy is on good footing. What was interesting yesterday, I thought, was Vice President J.D. Vance telling the American people, especially after a poll this week from Fox News shows that they are underwater when it comes to their handling of the economy, said, have patience with us. Let our policy start to infiltrate through the economy.
The problem right now is the calendar. The calendar's against all of this. The push to get lower interest rates. Later on this morning, 8:30 Eastern Time, we'll catch up with a major dove on the FOMC, Governor Stephen Miran, 8:30 on Bloomberg Surveillance. He's pushing for rate cuts. How do you persuade the rest of the committee, a divided FOMC, to come with you when you're not going to have the data in hand and you've got to wait another week for it?
There is this theoretical argument that's clearly taking place on the FOMC. What is the neutral rate? What is the rate at which you're not necessarily helping or hurting accelerate the economy or decelerate the economy? Right now, that is the ultimate note of disagreement, alongside what the Fed's role is trying to bridge in trying to bridge the gap between people at the upper end of the income sphere and people at the lower income. These are the existential philosophical debates that are being had at the FOMC, and I wonder what data they're going to point to, because frankly, it's a choose your own adventure, as you've been saying, cherry picking season on Wall Street.
When you say the philosophical debates, I have to say, Anna Paulson yesterday, candy sales over Halloween. For her, that's an example of how stretched some families are. Smaller bags of candy with fewer items sold better than larger bags that offered greater value per unit. And at the same time, demand for high-end chocolate is very, very strong. It's all in the candy, allegedly.
Check out the market this morning. Equities just about unchanged on the S&P 500. Messy, vicious 24 hours. Coming up on the program, we'll catch up with Cameron Dawson of NewEdge Wealth, with stocks on track for their worst week since April. Ajay Rajadhyaksha of Barclays on the biggest risk facing the economy. And Claudia Sahm of New Century Advisors on the path ahead for a divided Fed. We begin this hour with futures lower after AI fears drag down stocks to 2-month lows. Cameron Dawson of NewEdge Wealth writing, we see this as a valuation and positioning recalibration, not a growth scare, which implies a shorter and shallower correction. Cameron joins us now for more. Cameron, good morning.
Good morning.
How do you draw a distinction between one and the other?
Yeah, so what we think about is when you have a growth scare, it tends to lead to a deeper, more protracted correction. You're cutting EPS estimates, you're cutting GDP estimates. There's a lot of positioning to shake out. But at this time, we're not seeing signs that EPS or GDP estimates necessarily need to get cut for 2026. We think that they are very fully calibrated at this time, so we don't see a lot of upside to them, which suggests to us that this correction could continue, but it doesn't necessarily mean that we go into something that's greater than the 10% kind of drawdown that you would see in a deeper correction.
What do you think we need to see in the coming weeks, the coming month, to put a floor under sentiment?
So we think that we need to see a little bit of the weaker hand shaken out. What we saw with retail investors is a big 35% jump in FINRA margin loan balances over the course of the last 6 months. This suggests that there was just a ton of risk taking that happened really over the last 2 months. September and October, we've been calling it silly season. There was no reason for stocks to rally 30, 40, 50% in just 2 months alone. So a lot of this is just a recalibration out of that silly season into more rationality, but it doesn't suggest that maybe today is the ultimate low. We still think that we could see some volatility.
Are you buying?
For some accounts, yes. Look, at the end of the day, we always keep a book next to our desk, which is Walter Deemer's When It Comes Time to Buy, You Won't Want to, which just means that the narrative will suggest that you should stay on the sidelines of the market. Of course, it's scary, but we do know that forward returns get better as markets correct. And if we do see a correction down to, let's say, the 200-day moving average, the narratives will get even scarier, but that's an even greater opportunity to be able to put capital to work, because at that point, you've seen valuations come into a little bit more of a reasonable territory, as well as the fact that positioning likely would get a lot lighter.
When you take a step back, it feels like this is what happens when you invite bond investors to the party. That their valuations were flying high and doing great, and these companies were buying everything on cash. And then all of a sudden, you had a $200 billion in bond gluts and bond sales, largely tied to tech. And all of a sudden, everyone got depressed because suddenly it became a reality. You have to pay for this. Companies are having trouble paying for the hopes and dreams that they have out forward. How much is that going to be a theme, and that will temper any rallies going forward?
It's one thing to spend your own money. It's a very different thing to spend somebody else's. Because when you're spending your own money, you get the benefit of the doubt and the patience of we will see a return on this investment over a longer period of time. But as soon as you start spending other people's money, there needs to be a quicker return on that investment. And we've been surprised at how much bond investors were willing to step into some of these very long-term deals. So much demand for these bonds, even as you were starting to see things like CDS and credit spreads start to widen out. So we think that difference of spending other people's money has completely changed the narrative around the AI investment story.
So you think that potentially we had the Santa rally in September, October. What does this do for everyone's year-end targets for the S&P 500?
Well, isn't it interesting that bulls were clamoring to one-up each other, to raise the target, starting to say that EPS estimates were too low for 2026, and we simply just don't see it. You already had an acceleration in revenue growth that was contemplated in 26 earnings, as well as 150 basis points of margin expansion. So high bars just simply create higher potential for volatility, which is why we think that we're seeing this. The best news for this market, though, is that there are still cohorts of institutional investors that are underweight or neutral this market. You have discretionary investors that are still sitting mostly on the sidelines, which means that if you do start to see more of this volatility, it would be a good buying opportunity for this smart money. But the contrast to that is households are still very much all into this market. They've been a big source of the volume in the trading this year. So that's probably what we're starting to see shaken out at this time.
Do you want a good story to tell for 26? I think it sounds like this. Tax refunds in America in early next year. Stimulus coming out of Japan. China, reportedly, the team at Bloomberg talking about property stimulus emerging in China as well. Put it all together, is that a better backdrop for global growth in the next 12 months?
This is what a lot of the bulls are betting on. And this is the reason why the choppiness is in place, that a lot of people are saying it's a good time to buy. The bear case to that is that the AI jitters continue as bond sales do continue. And there is a deflation of the AI dream that has powered so much of the dynamism this year. And that, I think, is the thing that people are really worried about. What if all of that fiscal stimulus doesn't offset the sort of reality check that you're seeing in tech?
Forgive me for talking about fundamentals, because I do wonder how divorced this market is from any of the growth story developing anywhere at this point.
Well, look, at the end of the day, we've seen 12-month forward earnings estimates continue to make new highs and continue to get revised higher. And I think the question we have to ask is how much of those higher earnings revisions was banking on the idea of this CapEx story within AI continuing? When everybody was talking yesterday, when NVIDIA was up saying everything's fine in AI, the CapEx story is intact, we thought that that was a little bit misleading because the question about AI was not whether or not they were spending money. The question was, are they spending money in the right places and will they return any investment or have any return on that money? And so having good NVIDIA numbers doesn't necessarily suggest that you're going to see good earnings and margins coming out of those people spending on it.
What John was mentioning, though, is really important. And this potentially could be the playbook for the first half of next year. Do you think there could be a phenomenon where actually the index level goes down because AI is not driving, and you do see a broadening out, a sense that the rest of the economy is doing better? It's not AI's gain and everybody else's pain. It's AI pain while everybody else gains.
The lesson we learned from the tech bubble and the bursting of it is that initially everything goes down and then you start seeing divergences, meaning that when you are reducing overall equity exposure because the largest weights in the index are moving lower, you will see the broader index turn down, but then you start to see divergences begin to emerge. But the initial part is broad pain, and then you start to see certain things separate from the pack.
Cam, you're going to stick with us. Cameron Dawson there of NewEdge Wealth. Coming up on the programme, Governor Miran at 8:30 Eastern Time. Don't miss that conversation regarding the Federal Reserve and a big decision on December 10th. For now, let's get you an update on news worldwide with your Bloomberg Brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Good morning. President Donald Trump meeting with New York City Mayor-elect Zohran Mamdani at the White House today. The president posting on social media earlier this week, the communist mayor of New York City asked for a meeting. A Mamdani spokesperson saying the mayor and president would discuss public safety, economic security, and Mamdani's affordability agenda. U.S. banks shelving a $20 billion bailout plan for Argentina. The Wall Street Journal reporting that JP Morgan, Bank of America, and Citigroup are instead planning to lend the country about $5 billion through a repo facility where Argentina would exchange a portfolio of investments for dollars from the banks. A bidding war underway for Warner Brothers Discovery. Netflix, Comcast and Paramount Skydance all submitting offers for the company. Comcast and Netflix are most interested in the film and TV library, while Paramount is willing to buy the whole company, including cable channels such as CNN and TNT. And that's your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie later this hour. Up next on the programme, pushing for more rate cuts.
I think there are a lot of signals coming from the Fed, and some of them are very confusing. We don't know where things are. We've been cutting, and we should finish the cutting cycle.
That conversation up next with Bloomberg's Tyler Kendall, live from New York City this morning. Good morning. What a range on the S&P 500 in yesterday's session. At the highs, close to positive 2%. At the lows, negative by more than 1.5, and we closed close to those lows. On the S&P 500 this morning, we bounced by not even 0.2%. The Nasdaq totally unchanged. There's nothing convincing about this morning. Check out Nvidia in the pre-market. Nvidia right now is negative again by more than 1%.
Yeah, the fact that we're not seeing a buy-the-dip mentality and that yesterday you saw the biggest intraday swing going back to April after Liberation Day raises questions about where the marginal buyers are and what is continuing to catalyze these concerns. Is it weak hands, or is this something more fundamental, either about the debt picture or, frankly, something they're not hearing from Jensen Huang about exactly how some of the companies can actually pay for the chips that they're selling?
Nothing convincing coming from the economic data either, so that's unhelpful going into the Fed's meeting on December 10th. Under surveillance this morning, pushing for more rate cuts.
I think there are a lot of signals coming from the Fed, and some of them are very confusing. They've cut twice, and they've said that they're insurance cuts, so I would have thought that they would want to take out a third cut. We don't know where things are. We've been cutting, and we should finish the cutting cycle.
So here's the latest this morning. The White House ramping up the pressure on the Fed to slash interest rates with a December rate cut in doubt after a very mixed payrolls report. Joining us now is Bloomberg's Tyler Kendall. Tyler, the pressure really started to build this week on the Federal Reserve.
Right, exactly, John. And perhaps it's been heightened because we heard President Trump earlier this week tell the Treasury Secretary Scott Bessent directly that he needs to work on Fed Chair Jerome Powell to lower rates. We've seen the stakes perhaps been raised because this White House has been playing defense when it comes to the issue of affordability in recent weeks. Just look at the meeting happening today between President Trump and newly elected New York City Mayor Mamdani, where the issue is expected to be front and center. In fact, you had the Treasury Secretary go on in that interview to acknowledge that the administration has been frustrated with recent polling showing pessimism about the economy. Part of that is that the ongoing government shutdown had weighed on Americans. You heard the Treasury Secretary there talk about a insurance cut from the Fed. He went on to talk about this idea that there could be this hit to economic growth while the government was closed. Our own analyst at Bloomberg Economics calculate that the anticipated hit to fourth quarter GDP will have been 1.3 percentage points, but that the economy will likely get that back by early next year. But John, that just goes to the point that, of course, there is this lack of data, and the calendar is looking tricky, as the BLS confirmed earlier this week that we will not get another comprehensive look, particularly at the labor market, until after the December meeting.
Tyler, things were so quiet. They hadn't mentioned the Fed for so long. Are we blaming Annmarie for this?
Well, maybe because her question in the Oval Office did spur President Trump on to talk about what those potential replacements could look like. Of course, the Treasury Secretary, while putting pressure on the Federal Reserve, is of course also leading the search to replace him. He did confirm that we are expecting President Trump to meet with the top 3 finalists by mid-December. So as we get closer to that date, no doubt we're going to hear more about it.
Tyler Kendall with the latest down in Washington. Tyler, thank you. Annmarie, there was no mention of the Fed for ages.
I don't even know,
for weeks.
I don't even know why the president and the Treasury Secretary are now talking about they have to meet these people. He already said, I know in my mind who I'm going to pick, but I think he meant in his mind, he really just wants Scott Bessent to take the job.
Cameron Dawson of NewEdge Wealth still with us around the table. Cam, let's continue the conversation on the Federal Reserve. Just base case, what are you expecting now, December 10th?
We don't expect them to necessarily cut just because they've been so hawkish in their commentary. However, if we continue to see market weakness, we think it will be the reason why they would deliver a cut. Because if you wanted to justify a hold, what you did is you looked at broad financial conditions and you said equities are fine, credit is fine, volatility is low. You kind of have to throw that out the window if this correction continues, which just means that it could push them to deliver the cut in December, because then they could focus on the slowdown in job growth. If you wanted a jumbo cut, you'd look at things like the University of Michigan survey, you'd look at the Conference Board survey, which are showing or indicating that there could be even more weakness within the labor market once we get the data for October and November when it comes in December.
Do you think the pressure from the White House is counterproductive?
It has, I think, emboldened the hawks on the Fed to be more loud and push back even more and assert their independence. So this could be why we see the probability of a cut in December fall so much, because of the pressure from the White House.
Do you think if the Fed cuts rates now, that it would lead to a broad-based lowering in yields across the curve? Or do you think that it will lead to maybe the hawks in the market pushing back against long-term yields?
Not necessarily. It all depends on what economic data is doing. And this is where context does, in fact, change everything.
Lovely. You're welcome back.
Meaning that if economic data is turning higher, it does suggest that the long end of the yield curve will move higher. The reason that we haven't seen the big upward movement in the long end after the Fed has delivered 2 cuts is because economic data has been middling. So if you're in a resurgence kind of environment, what everybody's expecting for the first quarter, we would expect Fed cuts to be concomitant with an upward movement in the long end, which of course would further challenge more cyclical sectors and things like housing. So it could be a be careful what you wish for, but it depends on the growth backdrop.
What do you see in terms of the growth backdrop? I mean, how have you deciphered the Rorschach test that has been what we've seen recently in the data?
So what we've seen since the April lows is a movement in GDP forecasts for 2026 up from about 1.3% to 1.8% today. We think that that fully contemplates this idea that the consumer will hold in, but not necessarily reaccelerate. The big question is, do you get more fiscal stimulus that could broadly help the consumer? And I think the interesting plot twist is that if you look at fixed private investment, capital investment, that actually is turning lower in 2026. So despite all that we're talking about with AI investment and all of this CapEx, the rate of change is slowing down, because what you're seeing is a cresting in non-residential construction because manufacturing manufacturing investment is slowing down because the CHIPS Act is starting to slow down in its contribution to growth.
When you talk about the consumer, the White House is weighing whether or not potentially work with Congress, they can get stimulus checks of $2,000. Do you think that will actually help the consumer, or will it just feed inflation?
It likely will just feed inflation. It does, of course, depend on the supply side of things. One of the reasons why checks were so inflationary back during the COVID era is because you were giving people money and then there was supply chain issues, then they didn't have anywhere to spend it. But I think the real challenge you have is that if you start cutting the front end of the curve, you start giving checks, blowing out the deficit even further, you do get this dynamic where the back end of the curve likely picks up. We do know that the Fed or the Treasury is the one that wants these cuts so badly. We have over $1 trillion in interest expenses. You have $9 trillion of debt that has to be refinanced next year. And over 20% of the Treasury debt outstanding is in bills. So nobody wants interest rate cuts more than Treasury does. But the question is, can they explicitly express that in terms of Treasury financing versus just saying we're being too tight because of the economy?
If they don't cut in December, but they start cutting again next year, would it make a whole lot of difference?
No. And we think that we're going to get those cuts because we think that you have to think of this as old Fed has much more balance between inflation and employment. New Fed is going to 3%. They want to get to that 3%. That's what they've determined is neutral. I think the big question is whoever gets nominated to the Fed, what is their view of neutral? Is it deeper than 3%?
Who do you think is going to be nominated?
Waller. It's the most PC choice.
Is that what you think is PC? When the president says, I'm going to be politically correct, who do you think he means?
Waller.
You think he means Waller too?
Yeah.
OK, good.
Yeah.
Because I think there's a distinction to make there, for some people at least. A lot of people believe that's what the market thinks politically correct is, but to him maybe it's Kevin Hassett. And I keep bringing this up. If it's someone very close to the president, if it's not Governor Waller, if it is Kevin Hassett, do you change your view on how the market trades in terms of market-based assumptions on inflation? Your view on how treasuries might trade off the back of that?
The most fascinating thing is that 10-year break-evens on inflation are at 2.24% right now.
Solid.
The 10-year Treasury market believes that the Fed will be successful at getting inflation back to its long-term target. The question is that a reasonable assumption by the Treasury market?
Do you think it is?
No. Not right now. I think that there's probably upside to those inflation break-even expectations, mostly because there's absolutely zero desire to pull deficits in. You're talking about increasing deficits even further with direct checks. And so I think that the bias is upward on those inflation expectations. But again, that has to be in the context of what's happening with growth. If growth really does fall off a cliff, inflation expectations are well calibrated.
At this point, given the fact, I'm glad that you mentioned the deficit, that there have been so many different initiatives to try to lower costs for American families in response to some of these polls and the midterm elections. How much do you expect that to also drive the deficit into a deeper place, more significantly, potential rollbacks of certain tariffs, et cetera?
Yeah, that's the interesting thing about the tariffs is that it actually has been bond market positive because it has helped assuage some of these issues where the deficit was swelling and make it so that they haven't had to increase Treasury issuance as much. So if you get this pushback on tariffs where, heaven forbid, the money has to be returned, which we don't think it will be, but if you get this pushback on tariffs, does it make the deficits look even worse? Which then, of course, puts even more pressure to cut at the front end because you have that over $1 trillion of interest expense.
Cam, it's good to see you. Thanks for dropping by. Lots to think about going into 26. Cameron Dawson of NewEdge Wealth. Still lots to play for through 25 into year end. Still got to figure out the outcome of that Supreme Court hearing on the president's tariffs.
Absolutely. The Supreme Court could strike down IEEPA. It's the blunt instrument this administration has used for these reciprocal tariffs. It's bringing in billions of dollars. The issue, individuals will tell you, is even if the IEEPA gets struck down, the administration will find other ways to enact tariffs. The problem is, you brought up the timeline. Can this all be done in time to level out for the economy before the midterm elections?
What happened to that smooth sailing, melt up, risk reward into year-end story? What happened to that?
Record scratch. I mean, on one hand, you could say
the brakes.
On one hand, you could say you've got an amazing opportunity to get in at a lower level to really enjoy that Santa Claus rally into the end of the year, or you could say, wait a second, the debt folks came to the party, and they tend to be, party winners, as you can tell, and really lift the spirits of everyone because they say, really, how are you going to pay for this?
Slam the brakes on this rally. We're positive by 0.1% on the S&P 500, struggling to bounce. Up next, Ajay, Rajadhyaksha of Barclays on the biggest risk facing the economy in 26. Plus, Danny, how's your morning movers? Shares of the gap higher on the back of stronger than expected results. That stock up by 4.5%. Live from New York City this morning. Good morning. Check it out. Futures just about unchanged on the S&P 500. Big one-day reversal in yesterday's session, the biggest going back 7 months. We're heading towards the worst week on the S&P since the tariff turmoil of April. On the Nasdaq 100, here's a stat from the stocks team here at Bloomberg News. The S&P 500 is heading towards its worst November since 2008. On the Nasdaq 100, we have not had a 3-week losing streak. We haven't had a 3-week losing streak since March. It's been a long, long time. The Nasdaq so far this month is down by 7%. It's been a brutal November.
Yeah, and breaking through all technicals and coming with a meltdown of all momentum trades, but taking everything with it. And it raises this question, is this a fundamental shift or is this an incredible buying opportunity? And ultimately, that is going to be the debate. I keep going back to the fact that Bitcoin and just cryptocurrencies in general have lost $1 trillion of value in just a couple of weeks. And it gives you a sense of how fast things are moving and how much market capitalization is just being destroyed.
Loving the clicks. Just add something, you know?
Urgency.
Just perfect.
6:30.
Well, I mean, crypto. It's nonstop.
You know, it's just not happening.
5 p.m. somewhere.
There you go. Just like that yesterday, things turned around for Nvidia, and the losses continue so far this morning. In the pre-market, Nvidia down once again, negative by 1.7%. Let's get you some single-name stock level action with your morning movers. Here's Danny with more. Hey, Danny.
Hey, John. Some earnings to go through this morning. Intuit, those shares are up nearly 3%. They reported yesterday, and they beat on all fronts. They also signaled a lot of confidence around their AI product, specifically in their QuickBooks. They said that from small businesses, they launched this thing in July. They've had a lot of uptick. Apparently, it helps save 12 hours of accounting work a month and gets you paid 5 days faster. That's at least what they say. So that is making those shares attractive. Elsewhere, Gap also reporting earnings. A retailer that saw positivity, in fact, so much so that they have raised their guidance. Behind some of the success of Gap, of Old Navy, of all their different brands was the fact that they've done a lot of celebrities, a lot of collaborations. That's helping lift shares up 4.5%. Elsewhere, the bids have apparently come in for Warner Brothers Discovery. Those shares were higher by more than 1%. Now they're just up 0.8%. The good news for them is everyone is still in this process. It is Comcast. It is Netflix. The two of them want the film and TV library, and it's Paramount as well, who's willing to buy the whole company. So those shares, again, up 0.8%, John.
Story to track going into year end. Danny, thanks for that. Appreciate it. On our radar this morning, one of our top stories. President Trump set to meet the New York City Mayor-elect Zohran Mamdani at the White House later on today. It's the first meeting between the two leaders following months of contentious exchanges. Elsewhere, divisions of the Federal Reserve widening after Governor Michael Barr expressed caution over additional rate cuts. Barr joined by the likes of Beth Hammack, Austin Goolsbee, while officials like Waller, Bowman, Stephen Miran calling for multiple rate cuts. And finally, SoftBank shares plunging more than 10% as the tech-fueled pullback weighs on global stocks. The Japanese firm sliding despite offloading all of its shares of Nvidia in a signal the AI fears might be more broadly based.
Well, and it comes to SoftBank starts to invest more heavily in an open AI venture. So they are going into more speculative wagers in the AI world, which is exactly what they are ostensibly intending to do, right? The whole idea isn't necessarily to get out of NVIDIA because they think it's the top. It's to get into even more risk because maybe this is going to broaden out. It raises this issue again. Who are the most exposed players here? And especially with the circularity of the industry, the fact that so many different entities are increasingly dependent on one another. If one falls, how much is the domino effect going to really ripple through the entire ecosystem?
Keep going back to the numbers from Nvidia were pretty good. The company story's fine. The stock story's the problem. But at a company level, they're putting up tremendous numbers, even without the exposure to China. And there is a hint, you were down in Washington, there's a hint that maybe the door is opened a little bit more widely for them to sell to the rest of the world.
It definitely is opening to sell to the rest of the world. There's even conversations about if China comes back into play. Maybe when NVIDIA starts to build a new chip, Blackwell won't be the most advanced. You can go to China and they start selling those to China. But for sure, you're going to have the Middle East start to fill some of that gap. And the Commerce Secretary basically gave the green light for those chips to go to the United Arab Emirates as well as to Saudi Arabia?
Look, they're definitely banking on international sales and sovereign sales. I think the concern for a lot of people is how do people pay for these chips? Because one thing that people keep pointing to is that the accounts receivable, basically the bills that people hadn't paid to NVIDIA absolutely skyrocketed. So yes, their profits surged 65%, an astronomical figure. I mean, their numbers were absolutely blowout. But when you start looking at the forward trajectory of people being able to pay for this $5 trillion company, what they're actually asking for, that's where the questions start coming.
Things started to get shaky. I think radars were up around that Oracle OpenAI deal and just how solid the foundations were for that. That's when things started to get shaky. Then you had the debt issue from Oracle as well. Then you've had the debt issues from Oracle too in the broader market. We've seen all the charts of CDS. I get all that. This is the question that I've been asking for a while. 3 months ago, it was all about the strong balance sheets of the hyperscalers. We're built on strong foundations. The market shifted perception in the last few months, and I just wonder what it would take to get things back on track.
Probably profitability and use cases, and that's what people keep pointing to. Or maybe it's just a technical issue. But one thing that Gil Luria of DA Davidson said yesterday, OpenAI is the perfect example of fake it till you make it. They literally cannot pay for all of the plans that they are announcing. They cannot make these commitments. They are waiting for people to fill their coffers, whether it's through the debt markets or through other hyperscalers or other tech companies. So if you start pointing out the fake it till you make it, and I got to foot your bill. Again, when the debt investors come to your party, it might be time to close up shop.
That interview with Sam Altman didn't help.
You keep going back to that.
I know I always go back to it because it was so awkward. It was such a straightforward question. Your revenues are X, your spending intentions are Y. How does one inform the other? What's this going to look like in years to come? And it was like, if you don't like it, sell the stock.
Right.
I'm sorry, but come on, give me a break. If you had a central banker with the weight of the markets on their shoulders come out and behave like that in a news conference, what do you think the market would do? And I think there's a degree of responsibility for a CEO in that position, with the weight of the market on his shoulders, to come up with a better answer than, if you don't like it, sell the stock.
That works when you're talking to stock investors and you're almost a sort of rock star status in a world. It doesn't work when you're talking to debt investors, because they ultimately are going to look at the dollars and cents and say, hold up a second. Not working.
But also, he got frustrated in that interview. It wasn't just if you don't like it, sell it. He said enough. Clearly, the frustration was building because this isn't the first time he's hearing about these concerns.
The Nasdaq 100 futures down this morning by 0.2%. Sticking with tech, nervousness around the AI trade leading to the biggest one-day stock market reversal we've seen in 7 months. Ajay Rajadhyaksha, a global chairman of research at Barclays, writing this: the big risk for the US and thereby the world economy is if the AI narrative hits a wall in 26. We think fears of a collapse in the AI narrative are overdone. Ajay joins us now for more. Ajay, good morning.
Good morning.
Are we going to hit a wall? And if you don't think we are, why aren't we?
We are not hitting a wall. I hear everything that all of you guys said before, but I hear the accounts receivable argument with NVIDIA. These things happen in a hyper-growth CapEx cycle. They just tend to, 33 billion in accounts receivable is not the end of the world for a $5 trillion company. Every single hyperscaler that you talk to, forget the OpenAIs of the world for now, just look at the listed companies. We came through a phenomenal learning cycle. John, you'll have people telling you, well, the S&P is trading at a 20-year high on the equity multiple. What they don't tell you is that margins are at a 25-year high. They are at 14.8%, and the reason is almost exclusively big tech, where earnings are just killing it. It's not just one company, it's a bunch of companies altogether. And every single listed company, unless they are all lying, unless Musk and Ellison and Meta and Google are all lying saying they cannot keep up with demand for compute and inference over and over and over, we are not hitting a wall.
I hear you. The earnings are great. There's nothing wrong with the earnings. I've seen them too. We've all seen the margins. Fantastic. Great story. The way the stock's behaving has changed, and you've got to respect the market.
You have.
We repeat this all the time on this program. You can learn something from the information and something from how the market responds to that very information. What are you learning from how the market's responding to it?
How many weak hands there were, number one. Number two is how much of sentiment was driven by two other factors. One is, I think, Bitcoin. Even though a $2 trillion asset class should not drive a $75 trillion asset class, sometimes things tend to happen. And the third is, yesterday was a bunch of technical levels breaking in a technical-driven sell-off. Your 100-day moving averages break everywhere, and then we were off to the races. These things happen. April was a much bigger deal because you seem to have something fundamental change in global trade. And you know what? Why we completely blew past that? Because of the power of earnings. Unless you tell me that that's gone away for the listed names. I have a much harder time giving you a clean argument about the OpenAIs and the XAIs, because like you said, they don't make a lot of revenues right now. But Google and Meta and Apple, they make a lot of money. That is not changing anytime soon.
Ajay, do we need to reframe this? That what we're seeing is not the bursting of the AI bubble, but it's the bursting of the crypto bubble. This is the bursting of a Bitcoin bubble that is infiltrating the rest of the ecosystem.
So I won't say who, but one of the biggest holders of Bitcoin that has told me, and he's made the argument that he said, I've given up giving a use case for it. I hear you on that, the skepticism. The thing you're missing is that there is a gigantic layer of holders who are never going to sell under any circumstances. There is an inbuilt floor. Now, we don't know where that floor is. The story going around in the markets right now is that every 4 to 5 years, Bitcoin tends to halve before it starts to go back up again. And we are starting to get close to those levels. There's speculation about strategy having to liquidate. These are all stories and narratives. But this is an asset that does trade on sentiment one way or the other. And right now, the sentiment is negative. I don't think you're going to get to a point where 6 months from now I'm here and Bitcoin is at 10,000. That is not happening.
Well, I guess that my point is, we often talk about this as almost a vanity project for a lot of people to see what else can replace gold or replace the US dollar. And there's this question of how many speculative people can go into this before it becomes something real. I just wonder if we're seeing the $4.5 trillion market cap of this market start to move around the rest of the universe in a more significant way that has to be considered going forward.
I don't think yet, because so far we have, we were starting to get ICOs, internet coins start to become mainstream because they started to get into ETFs, they're starting to get into what you call TradFi, the traditional financial markets. Not enough yet. So I don't think there's enough of a flow. It is true that the triple Qs and Bitcoin move almost in one line, but they react to the same things. I don't think there is causality from Bitcoin to the equity markets yet, except for sentiment in short periods of time, which is one of those periods that we find ourselves in. Gold, the big move really has been central banks after the West froze Russia's FX reserves. It's not going away. And the weird thing about gold is that even with the fact that gold is up over 100% over the last 3 years, the amount of gold mined has not gone up almost at all. So supply has not rushed to fill in demand. So I think that's something that is more structural in my mind.
In your outlook, this line stood out to me. Traditional macro drivers like monetary policy will be less important next year. Isn't this story just heating up with the Federal Reserve? We're going to have a new leader in charge of the Fed.
So you can blame Haas for that, because I was doing an interview with her in Singapore 3 hours after the Fed meeting, and the first question was on OpenAI, second was on Meta. 5 minutes in, not a single question on the Fed right after the Fed meeting. But
I guess kind of like today.
That's right. But the easing cycle for the most part, I think, is closer to being done. The ECB is done. The Bank of England is very close to being done. The Bank of Japan might have 1 or 2 left. That is, 2025 was a series of cuts. As far as the Fed chair goes, the day that Governor Cook was let go, the one thing you would have expected, August 17th, shock to the market, would have been for inflation break-evens to widen. The risk is that monetary policy is going to become too easy, inflation should go up. Break-evens actually fell. The market seemed convinced, and so far they've been right, that the institutions will hold. And I think that's probably correct.
So what's going to be the driver? We had a tremendous amount of policy uncertainty this year. Does that continue into 2026?
No, I think the driver genuinely is going to be AI, because everyone focuses on AI capex. I feel comfortable about AI capex, that at least for the next 4 quarters, we are not taking a step back. People forget how much wealth effects, because of AI equities propping up the broader equity markets, mattered to consumption. Consumption is the big daddy of the US economy. I mean, you can't get past it. We've not created a lot of jobs this year. The housing market is moribund. We've had trade uncertainty. And the consumer has kept on spending because household wealth has kept going up. Peak to trough in the NASDAQ collapse in 2000 to 2002, we fell 78%. I'm not talking about anything close to that. But if you get a 30% pullback in US equities, and it sticks, we're probably going into a recession. And that will only happen if the AI narrative hits a wall.
So at the moment, you don't see the problems in the low-income groups in this country migrating up to the higher-income groups?
No, I think I don't. My story changes completely if we are looking at the equity markets being down 30% from here.
Does your story change if the AI revolution leads to severe white-collar job cuts?
So the weird part is, historically in expansions, this is not the first time we've had game-changing technology, right? The internal combustion engine, I would argue, was bigger because you had the horse and buggy for 1,000 years, and then something, completely changed. The weird part is that if you have an economic expansion, net job losses, regardless of Amazon announcing, we're going to let go of 30,000 people, things that hit the headlines, you don't get net job losses. You get net job losses when you get a recession, and then in the expansion that follows, companies say, there's this technology, I can do so many more things without people, and you get what is called jobless recovery. So I doubt that this time is going to be different. You will get headlines. I do think at the front end of the job market, there is a problem because not enough hiring is happening. And I think that is because of AI.
But can I ask you how unusual it is, just to take stock of 2025, to see the earnings story as powerful and as good as you describe it, and to see the payrolls growth as bad and as dire as we've seen it develop in the last 12 months? How unusual is that?
It is extremely unusual.
So it is different this time?
No, but what is... those are the four most dangerous words in finance. This time is different. So I'm hesitant to say that, but I think that is correct because you have historically, John, not had a 6 to 12 month period of such weak job growth that has then not led to large job losses and recessions. I don't think that happens this time because the vast majority of the lack of job growth is because of the lack of labor supply. The unemployment rate from a historical standpoint is still pretty low, and I think it stays that way.
There's a lot of people that hope you're right. It's good to catch up with you.
Fair enough.
Thank you, sir. Thank you very much. Ajay Rajadhyaksha there of Barclays on the latest story with tech stocks and the global economy looking ahead to 26. Let's get you an update on stories worldwide with your Bloomberg Brief. Joining us now is Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. Ukrainian President Volodymyr Zelensky says he's willing to work on a US-drafted peace plan that was developed with Russia. The proposals include demands that Kyiv cede territory and remove Russian sanctions, which Ukraine says are unacceptable. Zelensky says any deal must still guarantee a just end to the war. The U.S. ambassador to Japan says Washington has Tokyo's back in its ongoing dispute with China. George Glass accused Beijing of economic coercion and said some of the Chinese reaction has been, quote, outrageous. Glass also confirmed the U.S. treaty pledge to defend Japan, including over some islands disputed by Tokyo and Beijing. Gap shares rising in the pre-market. The retailer reporting stronger than expected third quarter sales. The company's Old Navy and Gap brands coming in particularly strong, with Old Navy generating nearly 60% of total revenue in the quarter. Tune in to Bloomberg at 9:45 Eastern for Lisa's interview with Gap CEO Richard Dixon. And that's your Bloomberg Brief. John.
Very cool. Looking forward to that chat, Vonnie. Thank you. Up next on the programme, growing divisions at the Federal Reserve.
Eventually, we are going to be back to rates can come down a fair amount. But in the near term, I'm a little uneasy front-loading too many rate cuts.
Up next, Claudia Sahm of New Century Advisors, live from New York City. You're watching Bloomberg TV. Down on the week, down on the session. We're down on the week by 2.9% on the S&P, down on the session by about 0.1%. On the Nasdaq, we're down by 0.4%. Under surveillance this morning, growing divisions and the Federal Reserve.
We've got a series of geopolitical and policy shocks that have come in that are masking, in my view, this underlying, the economy's pretty strong, and I feel like eventually we are going to be back to rates can come down a fair amount. But in the near term, I'm a little uneasy front-loading too many rate cuts.
So here's the latest this morning. The Fed's December interest rate decision very much in doubt. A growing number of policymakers expressing concerns over additional rate cuts. Claudia Sahm of New Century Advisors writing, the employment report for September didn't settle any arguments of the Fed, and that biases the Fed against action. Claudia joins us now for more. Claudia, welcome to the programme. Let's talk about that jobs report. What was your impression of it? Was that a strong report or a weak one?
It was a mixed report. I mean, you definitely saw the themes of job creation has been very slow. Payroll numbers were encouraging, but not encouraging enough. And frankly, a real warning sign in the report was that the unemployment rate moved up again. This is the third consecutive monthly increase that we've seen. And that really does reinforce that the weakness in demand is outstripping whatever slowing down in labor supply that we've seen this year.
That argument is the argument of Governor Waller and others, Claudia. I've heard that argument that we're close to stall speed and we should probably get in front of it. How compelling is that argument going to be on December 10th to the rest of the committee?
Frankly, I don't think there's a compelling argument on either side right now. We just don't have a real clear picture of what's happening in the economy. This was data on September, right? This is months past now. And what they're arguing about, I think rightly so, it's about the risks that are facing the economy. I mean, my base case is still that we muddle through this. We don't have a recession. Inflation comes back down. But I am very concerned, as is Governor Waller, about the downside risk to employment. I can see the case also for the risk of inflation getting stuck above target, right? So that's what they're arguing about, are these risks. And it's very hard to make a compelling case with the data that we have. So they're going to go down to the wire on this one.
Claudia, what's the difference if they cut in December or if they cut in January?
Well, so monetary policy takes time to work its way through the economy. So if what we're seeing are signs of a labor market that is slowing down to a point that it really goes over the edge, well, you would want to be doing those cuts as soon as possible. If you wait until you have clarity, if the Fed waits until it sees clear signs of deterioration in the labor market, they have waited too long. That's the big risk.
Claudia, they have seen signs of true deterioration, but it's in the lower income cohorts, and we're seeing that pretty consistently. And it raises sort of deeper question about the Fed. Is it the Fed's job to try to close the K-shaped gap that we have in the economy?
So the Fed's mandate is for the economy overall, right? They don't pick and choose demographic groups, parts of the country. Like, that's just not their mandate, right? And they don't have tools that are that finely tuned to think about specific groups. Now, what I will say is the Fed can look at groups that are typically marginalized, say, on the labor market. That can often be a signal of a broader weakness that's starting to build, right? Like, not everybody gets hit first, right? And so I think that is where they pay a lot of attention to where things are happening on the margins, but it's not that they can use that as a justification or kind of target their policy.
Claudia, since the Fed is going to meet and then 6 days later we get more employment reports, what do they need to be looking at that could potentially settle the arguments at the Fed before December 10th?
Right. So there is still information that the Fed will get before they go into their December 10th meeting. They'll get the JOLTS data, so they'll have another read on the hiring rate, the layoff rate for October on the first day of their meeting. We're going to get the Beige Book. I think the Beige Book could be really important for trying to get a sense of this argument about how resilient is demand. It's qualitative, but it is designed to be comprehensive, right? And I think that's one where we don't have the GDP statistics, and so we don't have these comprehensive measures of demand. That's going to be very important. I mean, they're going to keep gathering every piece of evidence they can. What is unfortunate is the piece of data that could settle the debate at the Fed is that November unemployment rate, and they're not going to have it when they vote.
Claudia, why can't they wait? Why don't we just reschedule the meeting? Is that difficult to do?
I think they would see that as being very disruptive. And I think to Governor Waller's point, it is a data-driven Fed, but it's not like it absolutely must have a data point, right? Like you do have to take what you have, form an outlook, think about the risk, make the case. I think what's just hard right now is they're missing, because of the government shutdown, because of, these delays that are just an unfortunate reality we have right now, they're missing some of these data points that would settle debate. So they're just going to have to work through this and come to the best, decision they can. But I think anything that be as abrupt as, moving the meat, they're just not going to want to go down that path.
Claudia, appreciate your time and your take. Thank you for joining us. Claudia Sahm there of New Century advises it's a Fed divided with a bias to wait, based on the majority of the commentary we've heard over the past few weeks. And without the data, you're not going to break that bias.
And they're not going to wait. They like their routine. They have tea time in the morning. They debate. They scream at each other. Then they release it. Fed Chair Jay Powell takes a big sigh. This is their monthly routine, and they're going to stick to it.
It's scheduled with intent, though, right? When that was scheduled, they thought they would have the data.
Yeah.
I don't know. Let's see what happens. Futures negative by 0.1% on the S&P. Up next, Stuart Kaiser of Citi, Stephen Scherr of Pretium Partners, and Savvy Syth of Raymond James.
The connection between the consumer and the labor market has never been stronger.
I think it's actually going to be a really tricky scenario for the Fed.
The Fed is going to maintain an easing bias, and that's ultimately what's important.
It's kind of like driving in the fog a little bit, although it's not as dense as I think some people think.
It's sort of a feast or famine economy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores look like this. The headline this morning, no bounce. We're down again on the S&P 500. Futures lower by 0.1% following the biggest one-day reversal since the tariff turmoil back in April. We're heading towards the biggest weekly loss in 7 months, and these moves aren't helping. Nvidia, your single name of the morning, the single name of the last 24 hours. Nvidia down by 1.9% today. Yesterday, positive, plus 5% at one point, then down and down hard.
Yeah, you saw the biggest intraday move yesterday going back to what we saw in April, the turmoil around the tariffs, and it raises this issue of whether this is a fundamental concern or, as Ajay Rajadhyaksha was saying earlier, this idea of weak hands being squeezed out. The argument on the fundamental side is that increasingly, yes, they're having 65% gains in profits and see a pathway to $500 billion in sales of their premium chips. However, there is a question about whether it is worth it for some of the people who are buying on the other end, not the hyperscalers, but people who are buying with debt. And then with the weak hands, those people are saying there still will be a rally heading into year end.
Nvidia down by close to 2% so far this morning. That's the stock story. That's the tech story. Let's talk about the Federal Reserve as well. Later this morning, about 90 minutes from now, we'll catch up with Governor Miran of the Federal Reserve. This is an individual pushing for another rate cut from the Fed on December 10th. He's got a problem. The rest of the committee doesn't have the data they need to change their mind. And the rest of the committee, many of them, are pushing to hold.
Claudia Sahm put it really well. Payrolls do not show the notable deterioration that someone like Collins is looking for. And at same side, they do not reinforce at this moment the stall speed, in her mind, that Waller is looking for, that Miran is looking for. But I imagine Governor is going to come on here today and say the unemployment rate is not just 4.4%, it's 4.44%. We're getting ever so close to 4.5%. And what happens 6 days after the Federal Reserve meeting, that unemployment rate ticks up?
That's the tug of war right now on the committee. Headline payrolls pretty decent, solid yesterday. Beneath the surface, though, unemployment, a concern. Continuing claims, timely data, also a concern.
There is a sense that it's taking longer for people to get jobs, that jobs just aren't as available. And this isn't just a supply side issue in terms of immigration and people leaving. It's also a demand side issue in terms of demand for those workers. That said, if you take a step back, there is a real question about the financial transmission of monetary policy and whether that is part of a feature or part of a bug, because I keep going back to what Ajay said. If the U.S. equity market declines by 30% and stays there, that will send the U.S. into a recession because so much of the spending power in the United States has come from higher stock valuations. Yes, it might be a bubble, but it has been fueling consumption at the higher ends. And that really is what has held up the economy.
There is at least one man in this administration who gets that, the Treasury Secretary, Scott Bessent, and the Treasury Secretary in the last 24 hours making a renewed push for, guess what, another interest rate reduction.
Well, the president also told him it's his job to fix it, or it would be his job on the line. Obviously, tongue in cheek, but in all seriousness, he does want the Treasury Secretary to basically make sure the timeline maps up for their three-prong approach when it comes to tariffs, fiscal, and monetary policy for their economy before the midterm elections. So he went on Fox News, and he's talked about the fact that you shouldn't stop during a cutting cycle, even though he says they're going to blame it on the fog. The issue they have is, of course, the midterm elections and a tremendous amount of uncertainty with the economy going into that. And that is why the Vice President of the United States is asking for patience from the American people when it comes to their policies being digested in the economy.
This market is not going quietly into year end. Futures just about unchanged so far this morning. Vicious volatile moves in the last 24 hours. Coming up on the program, we'll catch up with Stuart Kaiser of Citi with big swings rocking equity markets worldwide. Scherr of Pretium on bringing affordability to housing, and savvy Syth of Raymond James as airlines brace for record holiday travel. We begin this hour with stocks little changed as concerns remain over the AI trade and interest rates. Stuart Kaiser of Citi writing, we remain cautiously optimistic the US equities will rally into year end, led by year-to-date winners as investors keep it close to the vest. Stu joins us now for more. Stuart, good morning.
Good morning.
It's good to see you. You've written about this the past few weeks, and I'm pleased you have. The shifting reaction function of this market to incoming information around the tech story. Can you just sort of flesh that out for us and explain what's behind it?
Yeah, I mean, I think what's behind it is it's a little hard to figure out. A lot of people are blaming it on lack of retail participation and retail pulling back. But I think if you look, and you would add NVIDIA to the list now, but if you had started, you would have said, Meta, Palantir, Oracle, kind of three poster children for this in the sense that Meta increased CapEx spending materially, stock traded off. That suggested you're not getting rewarded for more spending. Palantir, beat numbers pretty decisively, but valuation sentiment very extended there, kind of stock pulls back. You look at Oracle, stock has round tripped a 40%, rally on earnings, and the credit spreads have probably gotten more press coverage than they necessarily deserve. But it's been a stark move, wider in those credit spreads. So it does seem like there is some AI fatigue. Positioning, valuation, sentiment is already very long. I don't really think this is weak hands being squeezed out. I think it's where is the incremental buyer at this point. I think you have a lot of people that are convinced about this theme, are invested in the theme, but you need that sort of next person to come in and push it higher. I think the sentiment yesterday morning on NVIDIA was not how much are we going to rally? I think people are saying, geez, I really just hope we hold these gains. I hope we keep this 5 or 6% gain. And that just shows you the shift in mentality and the shift in reaction function to this story right now.
What do you think changes it back? What can put a floor under sentiment and shift perception of the market back to where it was?
It's a really high bar here because you can't say we haven't gotten good headlines over the last month, right? So I'm sure you'll get a continued, string of announcements of deals and spending plans and CapEx, which you also got from NVIDIA. It's hard to see if there's maybe it's just going to have to be a mass or, accumulated critical mass of that news that kind of pushes you through because, look, I mean, even NVIDIA does 4 earnings reports. They do 4 GTCs. They do, inter-quarter updates, and you get all of those from all of their peers as well. So you can't argue it's a lack of information or a lack of bullish commentary. So I do think it's a little bit of a critical mass issue. Some people would argue you need to get price and sentiment a little bit cleaned up for that to work. Unfortunately, that would argue for lower markets, which I'm never going to advocate for, of course. But, I think it's a critical mass issue. There's not one big thing that I can think of. Some people have pointed to, well, if you allow China to kind of import some of these chips, it opens up a new revenue stream. That's obviously geopolitically charged, so it's not something I would expect in the near term. But you probably need something like that to really change the narrative.
So you said that there isn't the marginal buyer. And I'm wondering if we can finally put this fiction to rest of cash on the sidelines. Has the cash on the sidelines evaporated?
It certainly feels like it. I mean, if you look at FINRA margin balances in retail accounts, they're exceptionally high. Cash balances, I think, in most accounts. I think B of A had a note out on this last week that you all highlighted that those cash balances are pretty low. I think there's also perversely a little bit of a calendar issue going on here, which is institutional investors have really struggled this year. If you have a decent year or you're up or outperforming, you don't want to mess it up in the next 4 to 6 weeks. So I do think a little bit like any incremental risk on the sideline is going to be very cautious about entering this market given the calendar year timing. So, to your point, there may be less cash on the sideline. I also think that cash that is on the sideline is going to be very, very circumspect about kind of stepping in here.
What's the role of the retailer here, the retail trader that has driven so much of the volume, if not necessarily the overall dollar amount of trading? I just wonder if there is a connection between some of the high flyers, I'm thinking of crypto assets and things of that nature, and the willingness to spend money and put money to work on the part of the retail investor.
Yeah, without a doubt. I mean, our retail favorites list is down 22% from the highs. You've seen a significant pullback there. To your point, volumes on the retail side were called 16% of total. They're down to 11% of total. There's a clear relationship there. We can all see the chart of Bitcoin. We know what's going on there. So it does feel like retail is pulled back. And also that impacts, I do think, a little bit the institutional investor mentality, because I think in their view, they assume that retail was there to sort of buy the dip, right? If you pull that back a little, well, then again, that makes institutions a little more cautious of if they're not buying the dip, who is? Oh, I am. And now it's a risk question.
Hold on a second. Are you saying that retail money is leading institutional money right now?
I don't think it leads institutional money, but you have to look at the ecosystem of supply and demand of the markets. And retail is large and was very, very active. And if you pull them out, then as an institutional investor, I need to look around and say, okay, who are the buyers and the sellers, and what is their level of commitment? And it's at minimum going to change how you sort of risk adjust the market performance.
If individuals don't want to mess up their book going into year end, and what we've seen time and time again this year is that NVIDIA falls, the next day, everyone is stepping in to buy that gap. Why is that not happening as much?
I think part of it is retail step back a bit. I think part of it is the stock's massively high and expectations are so extended. I mean, if you look at EPS for NVIDIA, consensus was expecting like $6 of earnings back in June, and then it was 7, and then it was 8, and now people are talking about 8 to 10. So I do think, there's only so far you can kind of push these numbers. And again, for an institutional investor, this becomes a risk-reward argument. And it's, if I'm already here on revenues and I'm already here on earnings expectations, what is my incremental upside from here if I pull back 2 to 5%?
And I know Jonathan's already asked this question, but I want to try to get at it again. So then how do you get a year-end rally?
I think, how do we get a year-end rally? One, incoming data would help, claims and stuff like that. That would potentially be an incremental positive there. Otherwise, I think you just get volatility to calm down a little bit. As I mentioned, retail institutions being careful. We've definitely seen an overshoot in the VIX. We've seen an overshoot in implied volatility and risk pricing, and releasing that, releasing that risk premium back in the market could help.
The government taking equity stakes?
I actually don't think the market would respond too positively to that right now. One area we haven't talked about, though, is you're going to get Black Friday, you're going to get Cyber Monday, you're going to get a holiday spend season. If that data looks decent, I think that can get you there, particularly if continuing claims and jobless claims kind of calm down a little bit. But yeah, there's not a clear sort of I need this or I need that in the next 2 to 4 weeks to get markets higher.
No more questions. You're killing him. He's losing his voice. Stuart Kaiser of Citi. He's going to stick with us.
The president.
Get a drink, Stu.
I will.
You take a beat. All right, let's get you an update on stories worldwide this morning with your Bloomberg brief. Let's cross over to Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. A fighter jet crashed during a demonstration at the Dubai Air Show. The Indian Air Force confirming the accident and saying the pilot sustained, quote, fatal injuries. We'll continue to follow the story throughout the morning. Bitcoin is headed for its worst month since the crypto collapse of 2022. The cryptocurrency has plummeted over 30% from its record high set early October. Institutions appear reluctant to buy the dip, with a group of 12 US-listed Bitcoin ETFs seeing more than $900 million in net outflows just yesterday. Eli Lilly and Novo Nordisk announcing plans to start selling their obesity drugs directly to employers. The companies are hoping the new process, which starts January 1st, will expand access to the costly weight loss medicines. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes' time. Up next on the programme, Mamdani at the White House.
If anyone can show a nation betrayed by Donald Trump how to defeat him, it is the city that gave rise to him.
He's a communist. I don't think our country is ready for a communist.
So this is going to be fun. Box office down in Washington, D.C. Bloomberg's Tyler Kendall joins us next, live from New York City this morning. Good morning. Got a changeover at Morgan Stanley, a new Fed call from Mike Gapen. We no longer expect the Fed lowers the Fed funds rate in December, pretty much in line with market expectations. Some others have got some other views. Citi's Andrew Honhos with this to say: we think the steady rise in the unemployment rate will be enough to encourage open-minded officials to support a rate cut. Just how many open-minded officials are left on the FOMC going into December 10th? Because there was something for everybody in yesterday's report. If you're just joining us this morning, good morning to you all. Equity futures on the S&P 500 negative again today. We're down by 0.2% on the S&P. Very vicious moves in the last 24 hours. The biggest one-day reversal going back to the tariff turmoil of April. But yesterday, there was no single catalyst for that reversal. And that's what makes this particular moment particularly unique. NVIDIA came out with decent numbers. The stock was up by 5% and then banged down and down hard.
The tone has been shifting, and it's been shifting pretty considerably. It's interesting to see that tech has actually led the decline in all markets. You see the NASDAQ underperforming the equal weight S&P 500, and it comes amid concerns still about the U.S. economy, and it comes amid concerns about the Federal Reserve cutting rates. If this was a pure Fed rate cut bet, you would expect the Russell 2000 to underperform, and it hasn't. So there's something else going on under the hood, which is the reason why we're talking about technicals and weak hands and how much the market was up before, and whether this is just a sort of blow off top that will then give rise to yet another gain.
NVIDIA down by about 11% on the month so far. It's been a pretty tough month. The Nasdaq's down by about 7%. It's been a very difficult month for the tech story. In the bond market, just range bound. Check out twos just between 350, 360, just kind of anchored there. Fed's going nowhere anytime soon in the minds of a lot of people in this market. 2's around 3.52, 10's around 4%. I feel like that's been the story now for the last few months.
And frankly, the stability here has given a lot of people confidence that we aren't going to get anything extreme either on the Fed independent side, on the rate cutting side, or if they are delayed in terms of the December rate cut, they will cut again in January. What I think is interesting is how much the market seems to be coalescing around a view that inflation is contained, albeit above that 2% level, and that ultimately the Fed will cut rates, but the neutral rate increasingly is hovering around that 3.5% level. So the Fed can be debating it. The market has voted. And neutral is 3.5%, 3.6% according to market participants.
Still waiting to see if we get that CPI data sometime soon. Hopefully we will. The calendar, as you know, looks like this. Decision on the 10th from the Federal Reserve. 6 days later, a lot of jobs data still to come. Coming up on this programme, in about an hour and 13 minutes, we'll catch up with this man right here, Governor Miran of the FOMC, who's making another push for another rate reduction. We'll catch up with him in about an hour from now. Under surveillance this morning, let's head down to Washington, D.C. Mamdani at the White House.
If anyone can show a nation betrayed by Donald Trump how to defeat him, it is the city that gave rise to him.
He's a communist. I don't think our country is ready for a communist.
I have 4 words for you. Turn the volume up.
He has to come right to this building to get his money. And don't worry, he's not going to run away with anything.
I will not be intimidated by this president. I will not be intimidated by anyone.
So here's the latest this morning. President Donald Trump and New York City Mayor-elect Zohran Mamdani meeting at the White House today. The discussion following threats from the president to potentially suspend or cancel federal funding for the city. Bloomberg's Tyler Kendall joins us now for more. Tyler, just describe how we got to this moment. What's this going to look like later on today?
Yeah, hey, John, well, it really does feel like a made-for-TV moment, though the stakes are incredibly high for millions of Americans. We saw both of these leaders on the campaign trail really ramp up their criticism against each other. And now Republicans have been using Mamdani as sort of the foil ahead of the midterm elections. But there is a lot at stake here. As you mentioned, President Trump has previously threatened to withhold federal funding from New York City, which received $10 billion from the federal government for fiscal year 2025 and is banking on an additional $7.4 billion for fiscal year 2026. Plus, take into account that the Trump administration has already frozen about $18 billion worth of broader New York State infrastructure funds when the government shutdown began. White House Press Secretary Caroline Leavitt was asked yesterday whether or not these two leaders would discuss unfreezing those funds when they meet, and she said that we'll just have to see how their face-to-face meeting goes. Now, it's our understanding that Mayor-elect Mamdani requested this meeting with the White House. His transition team says that they will focus on affordability as well as public safety, as we know that this White House has been trying to recapture the narrative around costs. So potentially there could be some room for cooperation here. I will mention I spoke to one Democratic strategist who told us we shouldn't underestimate President Trump's affinity for New York City. But of course, that would be the optimistic view because they have been ramping up the criticism. And John, President Trump's threats go beyond just withholding federal funding. He still hasn't ruled out the idea that he could send the National Guard to New York City or ramp up immigration enforcement raids as well.
Tyler, they both ran a campaign around affordability. Mamdani wants to have free buses. The President of the United States is talking about $2,000 checks, dividend checks, when it comes to relief for Americans. When it comes to affordability, are they actually that far apart from each other?
Well, it depends how they approach their policies, right? Mamdani, for example, is proposing that he's going to fund his agenda by raising taxes on the corporations and the wealthy. Of course, that would go against what President Trump has been trying to champion, including when it comes to his signature legislation that was passed earlier this year. So there is a divide there, but it is true. Both of them are trying to get at this idea that higher costs are hurting Americans. And it's been really interesting to see how this administration has been trying to thread the needle around the issue, because they have to say that the economy is doing well, but also at the same time acknowledge that we've seen consumer sentiment hit near record lows amid these higher costs. So as we heard from the Treasury Secretary and also the Vice President J.D. Vance, there has been this acknowledgement that there is frustration within the administration when we look at these public sentiment polling showing that there is pessimism about the economy. Annmarie, we'll see if there is any room for them to work together here, because it is clear that it is an agenda item at both of the top of these leaders' lists that they want to tackle together.
Tyler, thank you. Looking forward to this and your coverage. Tyler Kendall outside the White House this morning. Stuart Kaiser of Citi still with us. Stu, things are changing. Tariff relief, the prospect of $2,000 checks. Is there more to come?
We certainly hope so. I do think a lot of investors are actually pretty bullish about how the tax and spending bill will impact the economy early next year. So if you're looking for an area of bullishness, it would be we are going to get some better tax relief hopefully early next year. I think generally speaking, investors would prefer not to have to understand how the government is going to impact markets and would like them to just kind of allow it to operate on its own. But yeah, I mean, optimistically, I think you're hoping you get some kind of stimulus into the system, and maybe you're hoping corporate America, took a little bit of a siesta during the summer amid all the uncertainty and might kind of re-engage. So I think that's your positive spin. I'll leave the negative spin up to you guys.
Stimulus in the system from the one big beautiful bill or brand new $2,000 checks, which could potentially goose inflation?
I think the one big beautiful bill part is what people are focused on. Again, to your point on the inflation side, the last time the government tried to send money directly to investors, it sort of didn't end well for the Fed. So I think generally speaking, folks would rather they avoid that approach.
When you look at 2026 and the policy uncertainty, how much does tariffs still weigh? Or do you think that really was just a 2025 story?
I think investors have tried to put it off to the side at this point, mostly because of the China-U.S. stuff. I think both China and the U.S. kind of realize there's a little bit of a mutually assured destruction element to this if it goes too far in either direction. So the range of outcomes is sort of narrowed to the point that unless you go back to like October when Trump was saying 100% tariffs again, unless you get that extreme, I think the market is really trying to push this off to the side. Obviously, the Supreme Court cases are upcoming, and that'll bring it front and center again. But for the most part, I think, folks have tried to kind of move this into the tier 2 of market risks.
Well, to that point, you've seen all the headlines with respect to potential stimulus and potential pullbacks in terms of tariffs, and bond markets have been just shockingly stable. I mean, shockingly. John was just pointing that out, and I'm just wondering why that isn't some sort of tailwind for equities. Usually when you get stability in bond markets, that's actually a golden blessing for equity, for risk-on moves. So why are we not seeing that this time around?
It's a good question. Honestly, I've been surprised bond volatility hasn't moved more, and also rate-sensitive sector volatility hasn't moved more. So the market seems to be pretty calm about that. Why are equities up? I mean, equities have benefited from the rate cutting narrative. You mentioned small cap before. They've been a cheap beneficiary. I think the view here kind of is, we've already priced in a bunch of rate cuts. From here, how do I actually get lower rates? Well, you might actually have to get lower rates through a weaker economy, which the equity market's not going to like. So I think the market benefited from quote unquote insurance cuts into an otherwise stable economy. And now we're at a fork in the road. And the question is, what do I want? Would I rather rates steady and a sideways economy, or would I rather rate cuts with a deteriorating unemployment situation? I think the answer there is pretty obvious. We'd rather a stable economy.
I feel like every time we've spoken to you over the past couple of months, you've been pretty bullish. You don't sound very bullish right now. What changed?
Yeah, I mean, 3 or 4 things have changed. If I had to highlight the number one biggest change in the last month, it would be consumer earnings. Walmart, Target, Chipotle, O'Reilly Automotives, Costco. I mean, we could probably list 12 or 15 of these companies that have talked negative about the U.S. consumer. So, look, retail's pulled back. AI has gotten expensive. We kind of knew those things. The Fed is a little bit in an internal debate. But I think the biggest new information has been U.S. consumer companies telling you about, spending fatigue, the K-shaped recovery, price elasticity of demand. I think is a term that a number of companies have used directly. So if there's one thing that's changed for the negative to me, it's U.S. consumer earnings.
That, and you just got back from Europe, right? As you were saying. That'll bring you down. That growth profile will make you a little bit more negative about things.
Yeah, I would say that. Well, investors there are a little more conservative, a little more skeptical of U.S. AI valuations. But it's a beautiful, beautiful region with wonderful culture.
Couldn't agree with you more. I mean, I love it too.
They've exported such wonderful people to America.
Thank you, sir. Thank you so much.
It's hard to argue against
I'm going to assume you mean me.
Of course I do.
Thank you, Stu. It's good to see you. Thank you. Appreciate it as always. Stuart Kaiser of Citi. It's interesting to take stock of the year. If I told you back in April that maybe the story around tariffs wouldn't even be a top 3 issue for a lot of investors going into year end, you would not have believed me. But that's where we're at.
You couldn't have believed you with lots of things if you said that would have happened until now. I mean, with respect to the questions around Fed independence and some of the moves and the threats, and the fact that there is absolutely no consequence to bond markets, at least that have been incredibly visible for most people. There's so many different layers to this. Yeah, it's sort of been a strange, what a strange long trip it's been.
It's been pretty crazy. Still another month to go. We're down by about 1/3% on the S&P this morning. Up next, Stephen Scherr of Pretium Partners on how the rental market can help the housing crisis. Plus, Danny has your morning movers. Nvidia and other tech giants continuing to drag down this market. Nvidia this morning down by more than 2%. Down on the session, down on the week, down 5% from the all-time highs at the end of October. This morning, we're negative again by about 1/3% on the S&P. On the Nasdaq 100, down by 0.7 on the week. On the S&P, we're down by close to 3%. As we count you down to the opening bell, about 2 hours to go. Let's get you some morning movers with Danny Berger. Hey, Danny.
Hey, John. No bids are holding or really even materializing for the tech stocks that had that huge reversal yesterday. NVIDIA, that's still down 2.4%. Then Oracle, the poster child for widening spreads on its debt, also down just under 2%. AMD, again, one of the chip makers, also down 1%. So it continues to be a painful tech market this morning. One of the ironic things, though, is that while tech and AI-related stocks are doing really poorly, retailers are doing well. It's kind of the reversal of what we've seen in months past, and that has to do with earnings. Yesterday was Walmart. Today it is Gap. That's outperforming, up 4 1/3% after it raised its guidance thanks to the success of all of its brands, but really a lot of celebrity and various collaborations. Finally, the other painful part of this market is crypto. Down 7% Bitcoin is this morning, below 81,000. So all of these crypto-linked stocks also in a lot of pain. Strategy down 3.5%. Riot nearly 4%. Marathon Holdings down 1.6%. The existence of some of these digital asset treasury companies, adding another dynamic into this market, maybe selling even more, making the pain in Bitcoin even more acute, John.
Danny, thank you. Thanks for the update. The latest for some single names out there to track what's happening in crypto and big tech. On our radar this morning, one of our top stories, European leaders rejecting key points of a peace plan floated by US and Russian envoys. Under the 28-point framework, Ukraine would cede large chunks of land taken by Russia while lifting sanctions on Moscow over time. Elsewhere, a major streaming shakeup on the horizon with offers coming in for Warner Brothers Discovery. Sources telling us here at Bloomberg that Netflix, Comcast, Paramount, Skydance all submitting bids ahead of the November 20th deadline. And finally, Fed Governor Stephen Miran reiterating his stance for more aggressive rate cuts, saying, quote, "It is incumbent upon us to move policy closer to neutral levels." We'll catch up with him in about an hour from now, and he has got an ally going into that meeting. This headline just crossed in moments ago. Let's bring it up. New York Fed President John Williams saying this in prepared remarks: "We still see room for a near-term interest rate cut." His view on things this morning. Off the back of that, we're down at the front end of the curve. We break 350. 349 on Tuesday this morning, down about 4 basis points. Underlying inflation continues to trend downward. Post-tariffs inflation back on track to 2% in 2027. That is a core member of the committee, a core ally of the chairman of the Federal Reserve, John Williams, making the case that we're still open-minded about cutting interest rates on December 10th.
And really pointing to the labor market, saying my assessment is that downside risks to employment have increased as the labor market has cooled, while the upside risks to inflation have lessened somewhat. So really taking a look at the fact that even though they have cut benchmark rates significantly, they haven't seen a commensurate tick up in expected inflation over the long term, the key argument of a lot of the people who'd like to cut next month.
On the inflation point, he says underlying inflation continues to trend downward, but there's an asterisk, absent any evidence of second-round effects emanating from tariffs. So basically, we have to maintain what we're seeing right now with companies not passing on the full breadth of the tariff impact, which, by the way, is still being debated right now in the Supreme Court, onto consumers for it to continue to ebb down.
Futures reversing just a little bit, just turning slightly positive on the S&P 500. We're up by not even 0.1%. In about an hour from now, we'll catch up with Governor Miran to get his thoughts on policy going into that December meeting. Turning to affordability, mortgage rates rising for the third consecutive week as high prices and weak demand weigh on the housing market. Joining us now is Stephen Scherr, co-president of Pretium Partners, an alternative asset manager focusing on real estate. Stephen joins us for more. Stephen, good morning.
Good morning.
It's
good to be with you.
Box office down in Washington, D.C. The president, Mayor-elect Mamdani, in conversation, talking no doubt about affordability and what we can do to help people get on the housing ladder in this country. Can I get your thoughts on where we are and what you think needs to change?
Well, I think the mayor-elect has certainly put an issue on the table, which I think is quite relevant. The question ultimately are the policies that you put in place in order to address it. From my perspective on housing, you have two choices. On one hand, you can address it with credible policy that could bring more housing into the fold, because we're running with a deficit about 3 to 4 million homes relative to where demand is. Or you can expand the definition of housing in the context of how you fulfill the American dream and include renting, which is obviously where we are involved. It affords many people who either can't afford a home or are disinclined to invest in a home as a long-term investment to rent in a neighborhood that is better than the one they would otherwise afford as a home buyer. And so renting has become, I think, a credible opportunity, a more affordable opportunity. Rentals are 40% cheaper, like for like, relative to a home. And it gives people who either can't afford or are disinclined to buy at the moment an opportunity to live in a community with good schools, low crime, and really put their family in a good position.
People, as you know, are squeezed out. Many of them don't want to rent, they want to own. As you say, that's part of the American dream, and it's so much more than that to a lot of people too. It goes beyond the United States. I see this in the UK in a massive way as well. Some people believe that large-scale asset managers like yourself are part of the problem. Can you talk me through why you think you're part of the solution?
Yeah, I mean, we hear that, but the reality is, in the numbers, institutional owners of homes in this country are less than 1% of the total housing stock. And we're less than 4% of single-family units that are available for rent. And so I think the assertion that we are somehow influencing or manipulating that would be misguided. In fact, in terms of landlords, small landlords, so families that own a half a dozen to a dozen homes, are a significantly higher component of lessors or landlords than are institutional holders of homes. And so I understand where the rhetoric comes from and how it's sourced, but the numbers belie, that. I would also tell you that from a Pretium point of view, we, like others in the industry, invest an enormous amount of capital in the housing stock. That's inherently good for America. And for us, extending credit to home builders and developers is yet another avenue, again, to bridge this affordability question by putting more homes as regional banks, withdraw from that proposition.
Your resume is fascinating heading into this type of discussion. You were previously the CFO of Hertz, or CEO of Hertz, from 2002 to 2022 to 2024, previously the CFO of Goldman Sachs. It gives you a real range in terms of the change in consumer behaviors. Can you talk about housing and the idea of the American dream being to buy a home, how that's shifted over the past couple of years?
Well, as I said, the cost of renting a home is 40% less, like for like, than to own a home. Almost 55% of new household formation last year came by way of rental. And I think it's important to understand that while owning a home is definitionally part of the American dream, renting has become a very viable alternative. Again, for two groups of people, one that cannot afford to buy a home and one that's disinclined. This runs to the question of consumer behavior. At the moment, if you look at the dashboard that the consumer would consider, their wealth is higher just by virtue of their 401k. We could debate whether there's a bubble, but at the moment they feel wealthier. The job market is softer, but we're at or near full employment, so people have a job. Prices are high, but inflation is well off its highs. So you would think the consumer would come at this emboldened to buy a home or to invest for those that can afford. The reality is consumer sentiment is decidedly negative as it was during the financial crisis. So we're seeing people keep their hands in their pocket. They're not making that investment in a home. The marginal buyer is becoming a marginal renter because they can rent in a community that is better than where they would otherwise afford a home, and they simply don't want to make that investment. And I think while the home, again, plays a big component piece in people's definition of their own economic success, demographically, we're now in a place where people have many ways in which they can accumulate wealth. It's not just in the equity of their home. These are all considerations I think the consumer is taking as to whether they buy or they don't.
This is increasingly a policy issue, as John was pointing at. And one reason why a number of people on the Fed say that there is evidence that the economy is weak is because of the housing market. Stephen Miran will be on in less than an hour, Fed governor, who has made that argument and the goal to bring down mortgage rates by lowering benchmark rates. You recently had a study where you talked about the amount that mortgage rates would have to go down to create parity in terms of affordability between renting and buying. And it means that they would have to be cut pretty much in half. How feasible do you think it is for Fed rate cuts to get us to where we need to be in terms of the backdrop of mortgage rates to equalize the market a little bit more?
I mean, it's unlikely. Pretium has put out a chart where a picture tells an awful lot. And we look at what has to happen, as you say, to mortgage rates so as to create parity as between renting and owning. there's no world in which in the near term rates are going to get cut in half. And so you'll continue to see that imbalance. If you look at, and you'll have your guest on later, the forecast is for rates to sort of drift lower, but only drift lower and not come down materially. So you're going to have high interest rates, high mortgage rates, which are going to continue to weigh on the overall cost of owning a home. And so I think it's unlikely that we will see that, much as things will be stable and they'll drift and lower interest rates are better for the industry. You're not going to see that quickly as an impetus to get people back buying a home.
Stephen, how are you thinking about if Mayor Mamdani is able to get through rent freezes?
Well, I think it's unlikely that he will. We do not own homes in New York City, but as a resident of New York City, I obviously watch carefully at what's going on. As we started off this conversation, I think the mayor-elect is on to the right point, which is affordability is a very big issue here, nationwide, in places like the UK, as we had discussed. The question becomes, what are the policies to address it? I don't think freezing rent is going to solve the problem in New York. What developer wants to invest capital with the notion that their return on that capital is going to be capped, or frankly capped at a return that simply doesn't satisfy their bogey for return? So that policy is not going to work. Instead, I think it would suit the mayor to think about ways in which he can collaborate with developers. For example, the city sits on an enormous number of vacant or underused lots. Is there a way in which they engage developers with low lease costs on that for an extended period and make a trade where you could lease for 100 years plots of land in the city to a developer and then ask that developer to make concessions on rent? Those are some of the things the mayor-elect could do.
When you think about renting, where in the United States right now is the best bang for your buck? Because New York City rents are at records.
Yeah, well, I think in terms of absolute cost, there are cities all across the Sun Belt that are less expensive than New York. What we're seeing right now is a resurgence in interest in the Midwest and the upper Midwest. We're seeing a lot of people move into places like Columbus and Indianapolis and Kansas City, and we're seeing rents start to pick up from our business. But those areas, including those in the Sun Belt, from Arizona through Texas and Florida, still remain more affordable than they do in the major cities, including New York City.
Stephen, it was good to hear your perspective. Thanks for being here.
Great to be with you.
Sir. Thank you very much.
Very
Stephen
much.
Scherr there of Pretium. Let's give you an update on news worldwide and some market-moving news as well with Vonnie Quinn. Hey, Vonnie.
Hey, John. Yep. New York Fed President John Williams just speaking and saying he sees room for a near-term interest rate cut. Williams saying downside risks to employment have increased, while upside risks to inflation have eased, and that underlying inflation continues to trend downward. Fed Governor Stephen Miran, by the way, on surveillance at 8:30 a.m. Eastern. 4 men have been indicted on federal charges in a plot to export NVIDIA chips to China and Hong Kong. One of the defendants is a CTO of an AI company based in Virginia. The other 3 defendants were born in either mainland China or Hong Kong. They are facing a maximum 20 years in prison. Ukraine President Volodymyr Zelensky, along with European officials, rejecting key points of the peace plan floated by US and Russian envoys. Under the 28-point framework, Ukraine would cede large chunks of land to Russia. It would also cap the size of Ukraine's military while lifting sanctions on Moscow over time. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thank you very much. Let's add to that story. Bloomberg's Ollie Crook joined just now from Brussels for more. Ollie, good morning to you, buddy. What's going on and why is this so difficult to get across the line?
Yeah, Jonathan, I mean, this is the 28-point plan that really arrived kind of like a bombshell here in Brussels over the last sort of 24 hours when we actually got all of the 28 points spelled out by the Trump administration. The starting line, the beginning point of the negotiation between Ukraine and Russia has landed very, very poorly indeed for the Ukrainians and for Brussels. And as a consequence of that, now European leaders are reacting to it. We've just had a meeting between the UK, France, Germany, and Ukraine, and they have rejected. And rejected is a sort of strong term. We should say they've rejected parts of it, but that's really really, they've gone very diplomatically with this, saying that they really agree with the United States in their diplomatic efforts. They would like to see this advance further, but they want certain things to be sort of red lines. And one of those things is that the line of contact to serve as the starting point for any understanding that the Ukrainian armed forces remain capable of effectively defending Ukraine's sovereignty. That is a quote from the Germans after that call from those four leaders. And they are reacting to points 21 and point 6 of the Trump plan, the first of which would basically now donate the rest of the Donbass region that is not fully controlled by Russia to Russia in this agreement as it is envisioned by the Trump administration. And of course, the second point there, point 6, is that the Ukrainian military would be capped at 600,000 personnel, which is a meaningful reduction in the number of forces that the Ukrainians have right now. And that is sort of the Ukrainian side of this conversation. But Jonathan, I think where European leaders are going to react in a much more sort of aggressive way, in a much more startled way, is there's a lot of these things within these points, within points 3, 7, 8, that put restrictions not just on the future of Ukraine, but what the NATO organization is allowed to do, whether or not NATO is allowed to deploy troops within Ukraine in the future, whether or not NATO is able to consider adding Ukraine to its numbers in the future. And in fact, one of the points here on point 3 is that says that NATO will not expand any further. And from the European perspective, and Jonathan, we've talked about this since the very beginning of the Trump administration and their negotiations on Ukraine, the Europeans are not at the table when it comes to ending this war in Ukraine. And increasingly, they do not seem to be at the table in creating the future architecture for security in Europe beyond Ukraine.
Ollie, with the latest. Ollie, thanks for this. Joining us from Brussels, breaking down the latest negotiations. This story from Reuters. Let's get into it. Ukraine is facing greater pressure from Washington to agree to the framework of a US-brokered peace deal with Russia than in previous negotiation efforts, including threats to cease provision of intelligence and weapons, according to two sources familiar with the matter, speaking to Reuters. The words of Reuters this morning.
So right now, this is just a threat. And what I see the administration potentially trying to do is carrot and stick approach for both of these countries. But yes, this peace plan that Oliver was just talking about was dead on arrival for Zelensky and for the European Union. Cutting off intel and weapons, that would be a much more aggressive approach threatening for Ukraine. And I imagine it's a deep debate within the administration because, yes, you have individuals like Steve Witkoff who worked on this plan with Kirill Dmitriev, but at the same time, you have really big supporters of Ukraine, like Secretary Marco Rubio.
Really newsy. Last 15 minutes or so. We'll get you up to speed on the price action too. Close to session highs on the S&P 500, up by 0.5% as the New York Fed President John Williams kind of reopens the door to a discussion of cutting interest rates on December 10th. Up next on the program, gearing up for holiday travel.
Thanksgiving will be great.
Okay.
Listen, we know the importance of Christmas and Thanksgiving and the holidays. That's our Super Bowl. And that's what we rehearse and plan all year long. We're going to be in really good shape.
We'll get the view of savvy Syth of Raymond James in just a moment, live from New York City. You're watching Bloomberg TV. This is a fragile market. We'll see if this move holds. We'll see if this sticks. But in the last 20 minutes of turnaround, equities positive by 0.5% as the New York Fed President, the highly influential John Williams, just reopens the door to a rate cut and that conversation for December 10th. Futures up across the board on the Nasdaq, up by 0.4%. On the Russell this morning, up by 0.8%. Under surveillance this morning, gearing up for holiday travel.
Thanksgiving will be great.
Okay.
Listen, we know the importance of Christmas and Thanksgiving and the holidays. That's our Super Bowl. And that's what we rehearse and plan all year long. We're going to be in really good shape. The good news is that the outlook is really strong, and the holidays will be a good test of that. We would see the return traffic from Christmas and New Year's looks really good. So I see no reason to think that this thing is going to slow down.
So here's the latest this morning. Airlines, travellers and the FAA gearing up for what's expected to be the busiest holiday travel season yet. Savvy Syth of Raymond James writing, we expect strong Thanksgiving holiday travel. Savvy joins us now for more. Savvy, before we get into Thanksgiving and next week, can we take stock of where we are right now and how much we've recovered and how quickly from what took place in the last few weeks?
Hey, Jonathan, good morning. You know what? I think we did see a hit, especially when you saw the DOT directed cuts. Especially from a demand perspective. I think that kind of hit demand. You saw TSA throughput fall as well with those cuts. But we've seen a strong, kind of a good recovery here in the last few days as things have kind of gone back to normal. And encouragingly, I think, it hasn't really touched that holiday travel demand.
Savi, a lot of people are looking to the air travel space to try to get a sense of the consumer. And we've seen that it's been an imperfect read, but a real-time read on exactly what sentiment's been like. Given the fact that the New York Fed's Williams, talking about potentially cutting rates next month and the idea of a softening labor market, are we seeing any signs of a similar read-through from the rhetoric of the airlines or any of the sales forecasts that they've come out with?
Yeah, we're not seeing anything yet from that perspective. Things are recovering. The airlines did get hit more than some other areas of the economy earlier this year when you had that heightened uncertainty. So I think there's probably a little bit of catch up happening as well here from a kind of a travel perspective. So nothing impacting that yet. And I suspect if there is going to be a kind of any impact on demand, it's probably going to be in 2026.
Talk about the airlines' costs, which have gone up pretty significantly. Savi, how much are they able to pass these along to consumers?
Yeah, there's been a lot of kind of over time, over the last kind of few years, there's been a lot of labor costs, a lot of, supply chain costs that have come in. But actually, more recently, it really has been fuel. If you think about it, fuel is about a fifth to a third of airline costs. And just in the last month, fuel is up 7% versus where it was in the third quarter. So in the holiday periods, I think airlines are going to be able to capture that. Not a lot of time to reset the prices here necessarily, given how close in these increases are. But in the off-peak periods, it is tougher to pass through. So we do need a strong consumer for airlines to be able to pass this through.
Savi, who's in the strongest position? And you're not allowed to say Delta. I want best of the rest. Who's in the strongest position right now?
Yeah, I mean, you look at the big four are in a really good position. Obviously, the legacy carriers, United, Delta, American, they have a lot more premium offerings and therefore a lot more kind of corporate exposure. And therefore, less price-sensitive travelers, so they should be able to kind of pass through costs a lot easier. Operationally, I think everybody's doing a good job here.
Good to hear. Savi, thank you. Savi Syth there of Raymond James. Good to hear going into next week and a very, very busy travel period in this country. If you're just joining us, welcome. Check this out. So equities up. Big move. A reversal of the losses from earlier on this morning. Futures positive by 0.6%. Of these words coming from the New York Fed President John Williams, who's making the case, saying, I still see room for a further adjustment in the near term to the target range for the federal funds rate.
When we started this show, there was a 37% chance of a rate cut in Fed funds futures come next month. Right now, it's 63%. That is how much the expectation for a Fed rate cut next month went up after New York Fed President John Williams made his discussion where he said he is seeing upside risks to unemployment and potentially labor pain. And he's seeing downside risks to inflation, really reiterating the dovish standpoint.
I also think this was interesting because he's taking questions right now. And he said clear communication can limit market disruption. Is this the clear communication that everyone stop freaking out? We are continuing our rate cutting cycle and we will be cutting in December. That's my question.
I don't know who's freaking out. I mean, Chairman Powell started this, right? It's far from a foregone conclusion. In the last news conference, he wanted things kind of 50-50, didn't he?
Well, clear communication from whom? Because a lot of people, Beth Hammack has come out and clearly indicated that she wants to keep rates where they are. Everyone has a clearly communicated view that is completely different from one another, and that's what the market's grappling with.
But not all Fed officials are created equally. It's very different for me hearing this from Williams.
Yeah, Williams top of mind, without a doubt. He is at the core of this committee, very influential alongside Chairman Powell. You wouldn't expect Williams to vote differently to Chairman Powell, let's put it that way.
Which is the reason why you're seeing the move in the markets. And interesting that stocks are rallying so much on this shift. That doesn't seem like that big of a deal. December, January,
Two-year bond yields this morning down by 2 basis points, 3.51. Some debate about what near-term means, of course. Is it December or early next year? We can get into that. In the next hour, Ulrike Hoffmann-Burchardi of UBS Global Wealth Management, Gil Luria of D.A. Davidson.
I don't think this is a bubble.
The market is still going to keep wanting some kind of proof.
I would look at it as a race to try to be in the lead.
This will be a buyable moment.
Momentum has been such a strong strategy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
What an end to the week. Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your price action looks like this. Following the biggest one-day reversal going back 7 months, equity futures this morning bounced by 0.5% on the S&P. On the Nasdaq, up by a third. In the bond market, yields down across the curve, 2s, 10s, 30s, 2s down 2 to 350.75. Off the back of this, the words of the New York Fed President John Williams opening the door to a conversation about rate reductions on December 10th.
This market feels like an unsatisfied king or an unsatisfied toddler saying, give me a reason to buy, give me anything, because right now getting 65% gain in profits just isn't enough. The fact that that New York Fed President John Williams is coming out essentially opening the door and endorsing the idea of a rate cut as soon as December and talking about the deterioration in the labor market is the thing that this market is looking for, and people are buying it across the board. The bond rally really speaking to what we're seeing in equity futures.
And the fact that he is saying he views monetary policy right now, we got the September payrolls report yesterday, we're not going to get the remainder of the data until after they meet, but he views monetary policy right now restrictive. And if you view it as restrictive, you think that potentially you need to take another cut. So we already heard from him, and now we're going to hear from Governor Miran this hour on this program, and they're going to really be leaning into the fact that they think it's restrictive. Unemployment rate's moving up, so why would you leave December without making this cut?
28 minutes away, 8:30 Eastern Time. Governor Stephen Miran on this program, live on Bloomberg Surveillance. He's got some company pushing for interest rate cuts.
So here's the real question in my mind, and I'm watching the Fed funds futures really price in a greater chance of rate cuts next month. I really can't get over the fact that the chance of a rate cut next month just doubled on what we heard from John Williams just moments ago. Now we're seeing a 65% chance of a rate cut from 37% when we started the show. So it seems like more than a coin flip toss that we will get a Fed rate cut next month. Is that enough to really lift the spirits of this market? What difference does it make if it's a December 25 basis point rate cut or a January 25 basis point rate cut? What does that tell you about sentiment in this market and how marginal the buyer is and what they need to really step in? To me, that's the bigger takeaway, given the fact we already knew there were doves. We already knew that there were hawks. If they cut 25 basis points in December, great. If not, they would do it in January.
Fragile. It's been a fragile 24 hours. Everyone's just a little bit on edge going into the Thanksgiving holiday next week. Me too. Things just need to settle down just a touch. Coming up this hour, Ulrike Hoffman-Burchardi of UBS with stocks tracking towards their worst week in 7 months. Gil Luria of D.A. Davidson remaining bullish on Nvidia despite the recent pullback. And the Fed Governor Stephen Miran as he continues pushing for more aggressive rate cuts. That conversation, 8:30 Eastern Time. We begin this hour with stocks aiming to end a roller coaster week on a positive note. The team at UBS Global Wealth Management releasing their outlook for next year, writing continued strong capex and growing evidence of AI monetization will fuel further gains for AI-linked stocks in 2026. We expect the S&P 500 to reach 7,700 by the end of next year. Ulrike Hoffman-Burchardi of UBS joins us now for more. Ulrike, good morning. Good to see you.
Jonathan.
Let's get to that price target. What's the road towards 8K?
So what we believe is that the macro headwinds that we were facing in 2025 are actually turning into tailwinds in 2026. We have that dual engine of both fiscal and monetary policy stimulus, in particular in the first half of next year. We have, of course, on the one hand now the rate cuts typically hitting with 2 to 3 quarters of transmission. Then we have the refunds from the one big beautiful bill, and we also have more investments into infrastructure and defense. So that's a very supportive fiscal environment. And then we think inflation is also going to be rather contained. We have 3 disinflationary forces in our mind that we are seeing. One, we are going to anniversary the tariffs in April. And then we have what we think is going to be slower wage growth because of the slack in the labor market. And then also finally shelter inflation coming down. So with that benign backdrop to inflation, we also think there may be one more rate cut in the books for December. But again, if not December, then January. And ultimately, as you said, it's the terminal rate that matters and not necessarily a 1-month delay.
You just offered us the ingredients for year-end melt-up, but it's not materializing. Mm-hmm. How would you describe what's developing before our eyes right now, in the last few days, the last few weeks?
Yeah, I think the key question right now is really about AI. And in our mind, the AI story has significantly changed. It's no longer about compute, it's about cash flows. And at the latest, in the third quarter Microsoft earnings, we learned that some of the big private companies that are offering intelligence services are actually still heavily loss-making. And the question is, will they generate enough cash flows to pay for all these commitments to infrastructure? And at the same time, what we're seeing is that the benefits of AI are going to actually be accrued by companies that are using AI. And I think that warrants a new playbook on AI investing.
So does this really mark the shift? I mean, is this the turning point that you see a new playbook as coming into play, for lack of a better word, as people look to who's taking on this new technology and deploying it in a way to increase their efficiency?
Yes, if we look just at the last 3 years, we're almost getting close to the 3-year anniversary of ChatGPT. We have seen that those AI 7, those enablers, the NVIDIAs, the Broadcoms, A&Ds, Microns, and then also the hyperscalers, that they have roughly gained about 10 trillion in market value over 3 years. Yet the AI users haven't really appreciated as much. And so for us, this is now the opportunity to pivot and invest in those companies that use AI for advertising, for coding, for automation of business processes. And we particularly think that the healthcare sector is a really interesting way to actually play AI.
So does this mean that you're going to see that rotation out of some of these large cap tech companies and into things like healthcare, things like financial sector, things like Walmart, as we saw yesterday, as they renamed themselves as a tech company? Or do you see this as potentially everything goes up, or the index goes down, but you see some winners in the bunch?
At the minimum, we think, or we suggest, that you diversify that AI monetization risk a bit. The math can work, of course. There's some path to that math working. But at the same time, there is a lot of uncertainty. Are all these private companies really going to make it? And I think for us, this is an opportunity to just broaden out our exposure to AI and rethinking how we want to invest in this. We don't think AI is a bubble. The technology is not a bubble. Technology is real, the ROI is tangible, but we want to now, again, expand our investment universe of how to capitalize on this new technology.
When you look at capitalizing on it and you look at the adopters you're interested in, say healthcare, other industries, does that mean job losses?
Not necessarily. I think it could also be of just doing more of what we're doing, or doing it faster and more cost efficient. You know, in healthcare in particular, the cost of bringing a drug to market has risen exponentially over the last few years and decades. And so AI can bring down that cost curve from clinical trial or drug discovery all the way to clinical trials. And I think this is a big opportunity for that sector to drive better operating efficiencies.
We've had a few of these conversations now.
Yeah.
And we often spend about 10 minutes with a guest. And I would say about 80% of it is on the stuff we just discussed. And hardly any of it's on Federal Reserve and interest rates. Now, we've just seen the market with a big turnaround this morning, at least, and Lisa's pointed out how viciously things have changed in terms of expectations. It makes me wonder just how relevant you and the team think monetary policy might be to the outlook, and how relevant it is for stocks going forward.
No, we think it's relevant. We actually use 3 perspectives in our equity framework, which is macro, which the Fed, of course, plays a big role in. We use also the bottom-up fundamentals, so valuation, right? That's a big part of our process, but also these structural trends like AI, electrification, and longevity, which for us determine asset prices. So for us, all 3 perspectives do matter. Sometimes the market decides to focus on certain areas of these 3 lenses. And I think as an investor, you have to stay attuned to where the market is currently focused and pivot. But all 3 are very relevant. Of course, over the last 3 years, it's been all about AI, and in particularly about AI enablers.
It has been totally dominant, that's for sure.
Which is the reason why it's hard to understand whether that hurts or helps the Fed's case to cut rates, because ultimately what people are saying is if the Fed cuts rates more significantly, that helps the valuation story proposition, the multiple story for AI stocks. But if they don't, then what does that do for the rest of the economy? I mean, there's so many questions here, which is the reason why you see the existential angst for a lot of these FOMC members about igniting a bubble in financial markets in order to help cater to the weakness that they're seeing in the labor market. This is a conundrum that they're going to have to grapple with, but they only have a dual mandate.
You've got 25 penciled in for December? Another rate cut?
We have 2 more rates cancel in, and really the reason, as you said, is the weak labor market and all the alternative data that we have been seeing. We now obviously have to wait until December 16th to know more about the labor market, but the data suggests that the labor market is still weak, and we think we have 2 more cuts.
It just seems ridiculous, doesn't it?
It doesn't need to be this way. Just
really
change the date.
It really doesn't need to be this way.
And I think if you do it immediately, it won't be seen as political. It will just say we want the most data we can have before we make a decision. I think everyone would welcome that.
Ask Governor Miran in 20 minutes' time. Let's move the date. move the Fed meeting. Ulrike, this was great. It's good to see you.
Thank you.
Ulrike Hoffmann-Burchardi there of UBS Global Wealth Management with an update on stories worldwide. Let's get you the Bloomberg brief. Let's cross over to Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. The US threatening to cut provision of intelligence and weapons to Ukraine in order to try and get it to agree to the framework of the peace deal it brokered with Russia. Reuters reporting the US wanted Ukraine to sign the deal by next Thursday. This news following a report earlier this morning that Ukraine and its European allies rejected key parts of the plan. The Congressional Budget Office is slashing its estimate for U.S. fiscal savings from tariffs by $1 trillion. The nonpartisan agency now estimates tariffs will cut U.S. deficits by $3 trillion over the next decade. The Trump administration is announcing new oil drilling operations off the coasts of California and Florida. The plan proposes 6 offshore lease sales between 2027 and 2030 to boost U.S. oil production. Lawmakers from California and Florida are warning it could harm coastal communities and ecosystems. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thanks for the update. Up next, the Morning Calls Plus. We'll catch up with Gil Luria of D.A. Davidson, remaining bullish on Nvidia despite a volatile, very violent move in the last 24 hours. That's up next. You're watching Bloomberg TV.
September and October, we've been calling it silly season. There was no reason for stocks to rally 30, 40, 50% in just 2 months alone. So a lot of this is just a recalibration out of that silly season into more rationality. But it doesn't suggest that maybe today is the ultimate low. We still think that we could see some volatility.
We've been spoiled. Up and to the right since the lows of April. I get it. We've been very spoiled. That was Cameron Dawson of NewEdge Wealth. And now we've had a 5% correction on the index level from the record high of October. Everyone always says they want to buy the dip, and then you get the dip. And everyone gets very sensitive about buying the dip because you've seen 5 and you worry that another 5's going to follow.
Yeah, and you see the dynamic shift. You see suddenly all of the pattern trading kind of fade away, all the technical trading fade away, and you start to wonder what else is behind it, especially when there isn't a reason to necessarily sell off. And as Cameron said, you always buy when it feels worse to buy. So does it feel the worst to buy right now if it's only been a 5% drawdown? I think that's what a lot of people are asking themselves.
We've got a turnaround this morning, so equity futures are positive by 0.5%. You'll see bond yields inching just a little bit lower. And if you check out the chart, you'll see a move developing about 45 minutes ago. Off the back of these comments from the New York Fed President John Williams, making the suggestion that maybe a near-term interest rate cut is on the table. So I get it. What is near term? I think most people think near term is December 10th.
Yeah, which is the reason why you're seeing the chances of a Fed rate cut really surge in terms of next month's Fed fund futures. But you raised the point about fragility. And I think that that is the most important point. The idea that people listen to what New York Fed President John Williams has to say. Yes, he is a more important Fed member. That could cause such a huge reversal in market expectations gives you a sense of how jittery and lacking conviction people in the market are right now.
More on the Federal Reserve in 15 minutes' time. We'll catch up with Governor Stephen Miran of the FOMC at 8:30 Eastern Time. Let's get you some morning calls. First up, Goldman raising its price target on Gap to 29 following positive results, seeing broad-based momentum in its Old Navy and Gap brands. That stock is up 6.5%. Your second call from BMO, raising its price target on Walmart to 125, seeing continued strength and consistency in its results. And finally, Raymond James, resuming coverage of Nvidia with a strong buy rating, viewing the company as the center of the AI industrial revolution. Even that stock is turning around now, higher by 0.7%. Let's stick with that name. The stock struggling to gain ground in the last 24 hours after closing more than 3% lower yesterday. Bloomberg's Mandeep Singh joins us now for more. Mandeep, a turnaround on that name, but what a vicious move in yesterday's session to see an 8% swing off the back of decent earnings on a massive, massive market cap. Mandeep, take a step back. What was your reaction yesterday at the close?
I mean, look, the numbers were great. Everyone realizes inferencing demand has been off the charts, and NVIDIA has been a major beneficiary. Though one other thing that happened this week was the Google Gemini launch, and everyone sees what Google has accomplished with $90 billion in CapEx this year. not only have they trained a new model, they're generating cloud revenue, they are deploying generative AI across their family of apps in a big way, so that efficiency when it comes to the data center scale is coming into play now, and everyone can see the proof point in Google's models and how it's running the infrastructure far more efficiently than an OpenAI, which wants to raise $1.4 trillion. So the next question is, what is OpenAI going to do with that $1.4 trillion? Because OpenAI right now is trained entirely on NVIDIA. And that's where I think everyone is looking at the ecosystem and saying Google has their own models, they have got their own chips, they're not reliant on NVIDIA, and they can do so much more in terms of efficiency, which is, I think, raised some doubts. But there's no doubt that inferencing demand is off the charts, and that's why NVIDIA is doing so well.
Mandeep, what do you think explains the shift in perception of market participants in the last few weeks? I would go back the last few months or so. We've seen several occasions of things that would typically be rewarded being punished, whether it's capex spend, whether it's agreements between a set of tech companies, whether it's decent earnings like we saw from NVIDIA. What do you suspect is behind that change?
I mean, right now, all these LLM companies, except for Google, are subsidizing the cost of deploying generative AI. Everyone is underpricing, and they are not even earning, an incremental gross margin. So everyone is questioning how long can you keep subsidizing the cost of generative AI, and when will you actually start thinking in terms of cash flow or, hitting scale? And look, I get it. They want to acquire customers, but $1.4 trillion is what spooked the market first. And then the circular financing and all these things kind of played a part. And then OpenAI trying to diversify away from the NVIDIA Microsoft stack and going towards AMD and Broadcom, I think that sowed further doubts in terms of what their ultimate strategy is.
Mandeep with the latest. Mandeep Singh, thank you, sir, of Bloomberg Intelligence. Gil Luria of DA Davidson remaining bullish on NVIDIA, reiterating his buy rating and price target of $250 on the stock. Gil joins us now for more. Gil, welcome. I think we've still got to reflect on what happened yesterday. How is this name suddenly looking so fragile?
Well, I think for the last couple of years, NVIDIA has driven the market. And yesterday, something happened around 10:45 Eastern, and the market started driving NVIDIA, something that really has nothing to do with NVIDIA. The results were very, very good. And more importantly, back to the conversation you've been having so far this hour, Microsoft, Amazon, and Google, NVIDIA's main customers, have all the customers. They have all the business customers through OpenAI and Anthropic. They have most of the consumer customers as well. And what they told us a couple of weeks ago is that they're seeing an acceleration in demand. So they're able to build out this compute infrastructure for contracts that are already committed. So their customers, which again is pretty much every other company and most consumers, are booking demand in advance and willing to pay for it. So to be precise here, Amazon, Microsoft, and Google are generating very good returns on their investment in terms of the build out of the data center. It's their customers that are not yet generating returns, but are booking so much demand in advance that it looks like they believe that they will generate those returns. So the results from NVIDIA reflected that acceleration in demand. They were very good. That's why the stock opened up. Something else happened yesterday at 10:45 Eastern. I imagine we'll find out. Something like a liquidation of a fund, somebody selling the AI portfolio as a whole. It had little to do, if nothing, with NVIDIA.
That said, Gil, and I hear you about sort of the technical selling or this question about whether there were some weak hands that were flushed out yesterday. There is this broader fear about NVIDIA, and you've seen it in the stock performance even leading into the earnings, that the earnings were not able to assuage. That, yes, people are willing to buy all these chips, but whether they're able to without borrowing a lot of money is another question. You talk about how there is this expectation of the profits to follow some of the spending, but you see the likes of OpenAI, as you yourself said yesterday, is the classic example of fake it until you make it. Why do the accounts receivables not concern you? The idea that this is a huge bill and the cost of it is leaving some looking elsewhere to try to raise the money.
Yeah, so it's a good, important question to start asking ourselves. What's healthy and real, and what's unhealthy and not real? So I talked about the healthy part. Amazon, Microsoft, Google, they're buying all the NVIDIA chips they can get. By the way, that does include Google. while Google is using its TPUs extensively, and by the way, the TPU is really the only competitive product in the market to NVIDIA. They're using it extensively. They're still buying as many NVIDIA chips as they can to help provide those to their customers. That's all healthy behavior. The unhealthy behavior you're mentioning has to do with startups borrowing money at very high rates, making promises they can't keep. That's the poster childs for that are OpenAI and CoreWeave, that really, and amongst each other, making these big promises, borrowing a lot of money to build data centers. That part of the demand isn't real. Now, importantly, it's not even necessary. If those two didn't exist, Microsoft, Amazon, Google would still be buying the same amount of chips, if not more. But we do have to keep pointing to the bad behavior, to NVIDIA giving $1 to CoreWeave, CoreWeave borrowing $9 and using 8 of the 10 to buy NVIDIA chips, then having to pay $1 of interest rate and only getting 50 cents of profit. That's unhealthy. That needs to stop.
Okay, but
you mentioned NVIDIA's receivables and inventory. That has come up yesterday. But if you look historically, we are still at this. These numbers are just so big that if you look at them as a ratio, so the accounts receivable as a ratio of revenue is actually within the historical range. Inventories is a percent of cost of goods sold within the historical range. So there's not a specific concern about those numbers for NVIDIA. It's more a concern about, are we letting bad behavior enter the system, which the main indicator of that is how much debt is fueling the data center build out. As long as it's cash on hand from the big players and their cash flow, that's healthy behavior that they're putting behind real demand.
Yeah.
If we start lending to upstarts to build data centers, that's the risk.
Gil, we just have about 30 seconds here. What do you think the blow up of some of the unhealthy players is going to look like for the healthy ecosystem?
So the shareholders and debt holders of those companies are going to get wiped out. But the big companies that I keep going back to, Microsoft, Amazon, Google, they'll end up buying assets at pennies on the dollar. So they're going to win anyway.
Gil, thank you, sir. Gil Luria there of DA Davidson. It would certainly take the pressure off them to spend as much as they're spending, because if they feel like they're facing existential risks right now, you wipe out some of the upstarts, the new competitors, maybe the pressure starts to come off just a bit.
Yeah, you hear about the likes of Meta trying to reserve data center space, not because they have the need for it right now, but they want to prevent, say, OpenAI to get it. In the meantime, you wonder about some of the bonuses that we're hearing for some of the AI talent as well, whether that also might have to come down if the competition isn't as fierce. Although if you're in the industry, good luck to you, and we're all jealous.
Nasdaq futures this morning higher by 0.4%, a turnaround this morning off the back of comments from the Federal Reserve. We'll get into it in just a moment with Fed Governor Stephen Miran as he continues pushing for more aggressive rate cuts. Plus, Danny has some of the morning movers for you this morning. Shares of Intuit higher on the back of stronger than expected earnings results. That stock is up by 3.9%. The opening about 60 minutes away. Equity futures on the S&P 500 look like this. We are positive now by 0.4% on the S&P. On the Nasdaq, we're up by 0.3. Moments ago, in the last hour, the New York Fed President John Williams just reopened the door a touch to cutting interest rates on December 10th. We'll get into that in just a moment. As we count you down, let's get you some single names, some morning movers. Here's Danny Berger with more. Hey, Danny.
Hey, John. This morning, Warner Brothers Discovery, it's up 0.6%. You have the bids coming in from Comcast, from Netflix, from Paramount. They're all still in this thing. Warner Brothers has wavered just how much it's gaining off the back of that, but the fact that they're all still bidding is obviously a positive sign for them. Only Paramount, though, out of all of them, would buy the entirety of the company. Other earnings we had Intuit, the financial services company, reported late yesterday, one of the best performers in the S&P 500 in the pre-market, up 3.8% this morning. They had a beat across all fronts, saying that their AI agent, specifically for their QuickBooks, has had a lot of adoption by small and medium-sized businesses. Finally, rounding things out this morning in terms of earnings, there's Ross Stores, another retailer alongside Gap, TJX, Walmart. that is reporting really strong earnings. Again, this is a discount store, so make of that what you will. They raised their guidance. Shares are up 3.5%, with the CEO saying that they have strong momentum heading into the holidays, John.
Hey, Danny, thank you. Thanks for the update. Check out Danny alongside Matt Miller in about 30 minutes' time to guide you towards the opening bell. Turning to the Federal Reserve, traders quickly reassessing bets for a December interest rate cut.
The downside risks to employment have increased as the labor market has cooled, while the upside risks to inflation have lessened somewhat. Therefore, I still see room for a further adjustment in the near term to the target range for the federal funds rate to move the stance of policy closer to the range of neutral.
So here's the latest this morning. The New York Fed President John Williams pushing back against hawkish commentary from the FOMC and Wall Street, now pricing in better than 50% odds the Fed will cut rates in December. Fed Governor Stephen Miran was the lone dissent for a 50 basis point rate cut at last month's FOMC meeting, and Governor Miran joins us now for more. Governor Miran, good morning. Good to see you once again. Thanks for being here.
Thanks for having me back.
We've got to start with the labour market. Your reflections on what we saw yesterday. Does it lean one way or the other?
Yeah, I mean, I think the implications of yesterday were obviously dovish, and if anyone was on the fence, I would hope that this would move them in the direction of cutting. I mean, you saw the unemployment rate edged up a bit. You saw some other indicators like an increase in permanent layoffs. Those are indications that the labor market has been affected by restrictive Fed policy. And given the outlook for inflation, there's not really much of a need to be as restrictive as we are.
And yet on the committee, we have pushback. Almost immediately after that, Fed Governor Michael Barr had this to say: I'm concerned that we're seeing inflation still around 3%. Inflation's closer to 3 than it is to 2. What do you make of that argument? How persuasive is it?
It's not persuasive to me, and I'll tell you why. Almost all of the inflation excess is a mirage. It's not indicative of supply-demand imbalances. And so, for example, if you look at the housing market, right, market rents have been running at about 1% for a couple of years. Measured inflation in the index is actually much higher than that because it takes a really long time for the index to converge down to where market rents are. That's a statistical artifact, right? That's an artifact of the statistical measurement process. It's indicative of a supply-demand imbalance that was there in 2022, 2023. Monetary policy works with lags. It has to be set now for 2027. So when you look at the housing data, right, you see market rents running about 1% for a couple of years. There's no supply-demand imbalance there. We should not be setting policy for 2027 based on a supply-demand imbalance that existed in 2022 or 2023. That doesn't make any sense. There's other things, too, like portfolio management services, which confuse quantities for prices. This stuff is all well known. If you look at market-based measures of inflation, they're much closer to 2 than they are to 3. So I think that the excess, the overage, is a mirage, and it's a mistake to ask people to lose their jobs because of quirks of the statistical measurement process.
And you've got to put out new forecasts on December 10th as well, which is going to be complicated by the fact we've had limited data more recently. How relevant do you think the calendar actually is? Because I'll offer you the perspective on Wall Street at the moment. It goes something like this. The meeting's on the 10th. You don't get the data until the 16th. The Fed's kind of constrained by that. They can't do anything. What's your perspective on that?
Yeah, so as I said a moment ago, monetary policy works with lags. It would be much easier if it hit the economy immediately, but it doesn't. It works with lags. So you have to set policy based on the forecast. So the data matter insofar as they affect your forecast. It doesn't make sense to be setting policy for where the economy was 3 or 6 months ago. We should be setting policy based for where the economy is going to be 12 to 18 months from now. And so if we have data, it gives us the ability to update our forecast. But the lack of data doesn't mean that we don't have a forecast. We did have a forecast. All it gives us is opportunities to falsify our forecast. And there hasn't been anything in the data, in the news, in media stories, in private sector data, alternative data that's available to us, that would make us think that the forecast is somehow nullified and there's been a big shock to it. So if anything, all the information that we've got in the interim since September FOMC has inclined to the dovish side. We got weaker inflation than people expected, and we got a higher unemployment rate than folks were expecting. So all of that information should push one in the dovish direction.
But there are still Fed officials that are looking for more data. And they have said they're data dependent. They want that insurance that they're cutting right now, and it's the right time. Potentially, the unemployment rate might be moving up to 4.5% on December 16th. Would you be in favor of just moving the meeting if it meant others felt more reassured to cut interest rates in December?
So, I haven't really thought about that, and it's not a conversation that I've been part of. I agree the meeting dates seem kind of arbitrary, but at the same time, there's a lot of stuff that gets done as a result of those meeting dates, and people have investments and contracts and other decisions that are tied to the timing of the meeting date, and I don't know to what extent moving those dates would be disruptive for all that. So it's something that I'm not sure about, but. this ultimately comes down to the question of data dependence is what you do when you don't have a forecast or when you don't have any confidence in your forecast, right? We should be forecast dependent, not data dependent. Being excessively data dependent is to be too backward looking. And if you're too backward looking, you necessarily are going to have the wrong policies.
Neil Dutter writes in, he says, the only question that matters for you is, will you dissent for 50 if you believe it means not being able to push through a 25 basis point cut?
Yeah, so absolutely not. I would absolutely vote for a 25 basis point cut if my vote were the marginal vote. There's no question about that. To do otherwise would be to cause real harm to the economy for purposes of vanity, and that's not who I am.
Going into next year, talking about the forecast of what's going to happen, a lot of economists who come on the show expect a reacceleration on the backs of the tax refunds and some of the other stimulative measures that could come early next year. How do you factor that into your forecast for ongoing weakness in the labor market and the consumer?
Yeah, so I think that, I have not been what I would think of as excessively pessimistic on the economy. I do think policy is restrictive, and I do think that it's too restrictive, and we don't need to be. And the longer we remain restrictive, the greater the chances that we are the source of an economic downturn, which we should not seek to be. I think that many of the factors that will be kicking in over the next 12 months that might be supportive of GDP growth are things that necessarily don't have hawkish implications for monetary policy because they affect the supply side. And when you think about things like relaxing regulations, and I think that has been going on at actually an impressive pace, these are things that push out the supply side of the economy and therefore don't necessarily create a demand excess of supply. Right? Monetary policy should be tight if demand is too much in excess of supply. And if you push out the supply side of the economy, then that's not something you worry about.
There's a duration mismatch here, though. The idea that if you reduce regulations and you allow people to build supply, that it takes a longer time than, say, if you give people $2,000 checks right up front that they can spend immediately, or if they get a rebate that's a lot bigger from their tax filings. How do you factor in that timing mismatch? Would you look through any bump up in inflation next year from both stimulative measures as well as the price increases that we're hearing from a lot of retailers that they're going to pass along?
So, I wouldn't look through bumps from checks like that, right? I don't think that you'd be able to. However, a policy like that hasn't been formalized. It hasn't been introduced. We don't know the parameters of it. It's too early to sort of think about basing a forecast on something like that. What we do know is that the labor market data have been coming in not as strong as we'd like them to be, and that policy is too restrictive.
Governor, if we can stay on inflation, do you know when we're going to get some inflation data? When are we going to get that? Because we've heard about the payroll schedule. I haven't really heard anything about the CPI schedule. You've got any indication whatsoever of when it's coming? Yeah,
the BLS put it out on its website this week. I think that we're not going to get the November CPI data until after the next FOMC meeting.
So we've got to wait for that too?
We've got to wait for that.
Did you see that, Lisa?
Yes, I did. I saw that we have to wait, and it's not clear exactly when we're going to get it, but there's a real question going forward about when we might get it.
But we don't have the dates yet.
But we don't have the dates.
No, the dates are on the website. Yeah, the BLS has a list of the release dates on their website.
I saw the payrolls one, but I've missed the CPI one. Yeah. Which doesn't that just make it an even stronger case just to wait and have this meeting when we've got all this data? Why is it that we have to wait so much longer for it, Governor?
Wait for the data?
Yes.
Well, because the government shutdown introduced a whole number of snags into the data collection process. And so those snags mean extra time to collect the data, extra time to process the data. People have a logjam of work to get back to. I mean, we just, sort of spent several years talking about bullwhips from supply chains, right? And, the demand gets pulled in at once. And when you have a government shutdown, all the government employees aren't working, and they come back to work, and they've got a ton of work to do all at once. And so, we have those bullwhips in government data right now. And, if that were a market, you'd see some inflation in the price of data. But it's not a market. So.
Forgive me for coming out with the hawkish hits, but we got another one in the last 24 hours too, and it came from Beth Hammock. Lowering interest rates to support the labour market risks prolonging this period of elevated inflation, and it could also encourage risk-taking in financial markets. Can we finish on that last point? Risk-taking in financial markets. How excessive is it, and should it be on the radar of the FOMC?
Sure. So first of all, as I said before, the excess of inflation is a quirk of the statistical process, and it is a mistake to ask people to lose their jobs as a result of a quirk of the statistical process. On financial markets, look, I think that lots of things affect financial markets. Tax policy does, regulation does, technology like artificial intelligence does. It's a mistake to conflate the status of financial markets with the status of monetary policy, right? Even when you look at something as a financial market as deeply connected to monetary policy like interest rates, we've lived through periods of conundrums, right, where passing through of the Fed funds rate into longer term interest rates was confusing to people. So it's just a mistake to do a one-for-one mapping of these things. And I think that when you look at financial conditions, the financial condition that matters most for the real economy has been and remains housing, right? And this is an area where financial conditions are not loose. This is an area where financial conditions are still quite tight. Going out, getting a mortgage, this is not something that's not a financial condition that I would consider to be excessively easy. And so I think it's a mistake. And I think it's also a mistake, as I said before, to ask people to experience job losses because you think the stock market is too high. I don't know what the right level for the stock market is. And I think that it's a very challenging question to be able to answer credibly, and to say that we need to create job losses in order to sort of restore the stock market to some level that we think is more reflective of fair value is just not a policy view that I hold.
A lot of people have come on this show and said that right now the Fed is stuck between a conundrum of the K-shaped economy, where you have people at the upper end who are doing just fine and are supporting consumption, and people on the lower end who are experiencing a lack of wage gains, and they're experiencing those job losses more significantly. How concerned are you about sort of your dual roles of trying to help prop up and prevent some of those job losses from really escalating, while at the same time potentially cutting rates would exacerbate that K-shaped and only exacerbate what you're seeing with respect to the wealth divide?
So Congress didn't task us with addressing all social problems in the world, inequality one of them. They tasked us with tackling aggregate maximum employment and stable prices. And so, therefore, the right policy to take is to stabilize employment and prices, and that's the policy that I support. I do think, though, while discussing the subject of inequality, it would be much worse for the people at the lower end of the income distribution if the unemployment rate continued to go up as a result of our policies. That's not something that they would welcome, and it's not something that I would welcome either.
Governor, I was with the president this week in the Oval Office, and I asked him about the Fed interviews. He says lots of names. We may go the standard way. Quote, it's nice every once in a while to go politically correct. Out of the names that we know that are being interviewed, who is politically correct?
I don't really know the answer to that question.
But you worked for the president, so you understand how his mind works. Do you think it means someone that is currently on the board, like a Governor Waller, or someone that's very close to him and your former colleague, Kevin Hassett?
Yeah, so, it should be pretty clear that I just always say what's on my mind, and therefore I don't even know what politically correct is. So I don't even know how to begin addressing that. But look, I don't make personal decisions.
You're being too politically correct right now, actually.
Am I? I've never been accused of that before. So, hey, I'm happy to have it first.
Governor, very diplomatic. It's good to see you. Thanks for dropping by.
Thanks for having me.
Thank you, sir. Thank you very much. The Fed Governor, Stephen Miran, with an update on stories worldwide. Let's get you an update with your Bloomberg brief. Here's Vonnie Quinn with more. Hey, Vonnie.
Hey, John. Thank you. Gap shares rising in the pre-market. The retailer reporting stronger than expected third quarter sales, a sign that its celebrity-fueled marketing and revamped inventory are helping to lure in customers. Stay tuned to Bloomberg at 9:45 a.m. Eastern for Lisa's interview with Gap CEO Richard Dixon. A bidding war underway for Warner Brothers Discovery. Netflix, Comcast and Paramount Skydance all submitting offers for the company. Comcast and Netflix are most interested in the film and TV library, while Paramount is willing to buy the whole company, including cable channels such as CNN and TNT. It was a defensive showcase in Houston yesterday as the Texans defeated the Buffalo Bills 23-19 in Thursday Night Football. The Texans' relentless pass rush sacked Bills quarterback Josh Allen a career-high 8 times and forced 3 turnovers as Houston improved to 6-5 on the season. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate the update. Up next, we'll set you up for the day ahead. Plus, we'll get Krishna Guha, his thoughts of Evercore ISI from New York City. You're watching Bloomberg TV.
the implications of yesterday were obviously dovish, and if anyone was on the fence, I would hope that this would move them in the direction of cutting. The labor market has been affected by restrictive Fed policy, and given the outlook for inflation, there's not really much of a need to be as restrictive as we are.
That was Fed Governor Stephen Miran weighing in on monetary policy, looking for an interest rate cut on December 10th. If you're just joining us, he's not alone. In his camp, the New York Fed President John Williams, almost there, just opening the door to an interest rate cut in the near term. Equities bouncing off of that. We're up by 0.5% on the S&P. On the Nasdaq, up by 0.5 also, up by 0.8 on the smalls. The Russell 2000 advancing. As we count you down to the cash open, here's the trading diary for the week ahead at 10 a.m. Eastern Time. UMich consumer sentiment. Then at 3, box office time. New York City Mayor-elect Zohran Mamdani visiting President Trump at the White House. Looking ahead to next week, PPI and retail sales Wednesday, another round of jobless claims, and the Federal Reserve releases its beige book on Thursday. U.S. markets, of course, are closed for Thanksgiving. Looking ahead to the Federal Reserve and the next meeting, Krishna Guha, the Vice Chair and Head of Central Bank Strategy at Evercore, writing the case for a December rate cut is to complete a mini-series of risk insurance cuts to guard against the risk of more serious labour weakness. Krishna joins us now for more. Krishna, welcome to the programme. How compelling is that rate cut argument for next month?
Look, I think it is as compelling as it was in September when Powell and the Fed leadership group indicated they thought 3 cuts were appropriate. Right? Since then, nothing has really changed. Of course, we have not had as much data as we would have liked to have. But such data as we have confirms the assessment before, which is that the labor side is soft, not yet weakening in a more scary way. But of course, the whole point of an insurance cut is to prevent that from happening, while the latest available inflation news is on the more constructive side. So not mission accomplished, but I think still reasonable grounds for delivering the third rate cut, the third insurance cut that Powell penciled in September. And I think Williams today is the tell that that is likely where they're going.
Krishna, could you elaborate on that? As Annmarie was saying earlier, not all Fed members are created equal, and New York Fed President John Williams has a premier spot in the trifecta of leaders that tend to exert influence over the committee. Yet we were talking about how Fed Chair Jay Powell has sort of lost control over the committee. Why do you think Williams is the tell, considering the disparate opinions that we've heard coming out of the board?
So you're raising some very interesting points there. Let me sort of unpack it quickly. First of all, I've said very forcefully that I think that this, understandable, difficult debate, fight over a December cut has been in real danger of turning into a crisis of governance at the Fed, with the committee polarized between doves and hawks, both on economic fundamentals and in response to pressures on Fed independence, and Powell really struggling to make policy the way the Fed normally makes policy, which is the chairman sort of crafts a central view that most people can sign up to. But it remains the case that the votes are just about there for either a cut or a skip, admittedly with multiple dissents likely, depending on which way Powell wants to go. So that then takes us to Williams today. As you rightly pointed out, the Fed has a leadership troika of the chairman, vice chair at the board, that's Jefferson, and New York Fed president, who's Williams. And Jefferson and Williams could be thought of as Powell's principal lieutenants in running the Fed. It would be extremely abnormal, I would say, a professional malpractice, if one of those members of that troika would come out with a statement like the one Williams delivered today without getting it run past and approved by the chairman first. So you have to read this at the bare minimum as saying that Powell hasn't given up on a debt cut. And I would say more than that. I think it's legit to read this as saying the leadership is leaning for a cut.
This, to me, is exactly how the market is reading it and is really illuminating in terms of also the comment from New York Fed's Williams saying clarity of communication is key for monetary policy transmission. Why do you think that this fracture has occurred? Do you think it's because of something about Fed Chair Powell's leadership, or do you think it's because simply there is this uncertainty around who's going to lead next year?
I think there's actually still enormous goodwill and respect towards Powell within the FOMC. And I think actually in just the last 24 hours or so, you've seen people on both sides of the debate among that wider group of Fed officials. Just back away a little bit from making categorical statements about what they will or won't do in terms of their vote. And I feel that that's intended to give Powell a bit more space to try to figure out which way he wants to call this. But the larger point is that the clock is running down on Powell's tenure. It wraps up in May. And the committee itself is being, I think, has become more polarized than I've seen it in many, many years because of the coming together of these genuine differences on the economic merits, the political pressures on Fed independence, which push some people more dovish, but push many others more hawkish to try to stand up for the Fed's independence. And of course, this process of, looking, yes, Powell is a guy everyone respects, trusts, but he's not going to be there for very much longer. And so folks also starting to look forward to the next round of this, the next era.
Is it actually more polarized, or is it just we're getting more insight into it because more Fed officials are willing, like Governor Miran just now, to come on and talk about where they stand?
No, I think it is more polarized. And the distinction I would draw is between folks talking about their views on the economy, their views on inflation, their views on, on labor, on the degree of restraint in the labor market, versus offering what look awfully like strong views in terms of where they're going to vote at the next meeting, right? The way that the Fed normally conducts business is it's not like the Bank of England, which has 9 members and the policy that wins is the one that gets 5 to 4 votes.
Yeah.
The way the Fed normally makes policy is it's a chairman-led process where the chairman tries to craft a path for policy that most people can sign up to. And those who have concerns address those mostly in private with the chair, try to figure out if they can negotiate something that they can all live with. Dissents are rare and very rarely sort of pre-announced in large numbers in public. What we've seen over the last few weeks is very abnormal, I would argue very unhealthy, with a lot of folks staking their claim in the ground publicly, not working with Powell to try to find a center ground here.
Krishna, we've got to go. Thank you, sir. Krishna Guha of Evercore, and a quick announcement from me. I'm taking some time off to support Mrs. Ferro on the arrival of baby Ferro.
Woohoo!
So I'll see you in the new year. As I say every year, you are the most intelligent audience on the planet, and I'm looking forward to making sense of 2026 with you in the not too distant future. From New York City this morning, good morning. This was Bloomberg Surveillance.